You guys can hear me?
Yep.
Yes, sir.
Awesome. How's everyone doing? Fantastic.
Busy.
Busy. Oh, yeah, I'm right with you. Just definitely bought some houses that are borderline tear down. So I'm pleasantly surprised when I got to one today, but figuring out the right plan. How's everyone else doing? Everyone's logging on. Talking money today. You guys are a quiet bunch tonight. Phil, how you doing, bud?
Hey, James. Yeah, all is hold on. Um, okay. Yeah, I've got a project that's closing next week, which I'm happy about in Bellevue.
Yep.
So,
Yeah, that market
th-
kind of picked up all of a sudden right there at that price point.
yeah.
Yeah, it's like
Um,
this last like 14 days has been a lot different than the last 60.
yeah, it seems like we had a lot of foot traffic, which was great. And maybe contributed to the situation. So happy about that. I've got one that's sitting for a bit. We made a price adjustment. Saw some foot traffic over the weekend, so hopefully that turns into an offer. Um, and now looking for a new deal. Um, so kind of where I'm at. Yeah, hopefully something that can take me into 2026.
Okay. Yeah, there's a good thing yeah, there's I'm pulling up your listing right now too. It's no right, keep letting people in. Yeah, it's weird. The price points you guys like anybody coming to market or that's on market, because I got a few sitting too. Where it's like you look at them, they're priced well, and it's a matter of the buyer activity is starting to increase. And it's like, do you adjust price or do you let it sit and work on giving away some price to kind of dragging an offer? Um, yeah, less shy where you are, man, I got a couple listed there. It's just dead right now. But the
Yeah,
traffic has definitely picked up the last 14 days. Like, I mean, I got one house priced in a better location, better renovation. We are 50 grand more than a house I sold 2.5 years ago for. And it's just, and this is a substantially better renovation and a better street. And it's just so less shy. I know some flippers, some bigger flippers too, that pull their properties off market because they're like, dude, and I'm glad we're not in their price points because they're in the $2 million range.
mm.
And that's really getting beat up unless you're on like a core street. But because right now, like your house is priced really well.
Yeah. I
It's
walked it today to check it out, and I was sort of admiring it. I'm like, this is a nice house. Like,
well, and you got a 2 car garage.
yeah. So
It's like the
hopefully
2 car
someone,
garage is like gold in the central district. It's
yeah.
just, it is the buyer activity. You know what it is? There's a lot of relo buyers in the market right now, and they're drifting. What I have found, and you guys, this is important in any market, like where are the buyers coming from? What I've seen more, Bellevue, Redmond is, there's pent up buyers that were sitting on the sidelines from the market. And then they started as the economy was looking okay, rates are starting, they just finally, that's what pulled the trigger, right? Like they're like, I'm going to miss out. Seattle, there's a lot more relo buyers I've noticed where they're going and checking out Ballard, Bryant, Queen Anne, West Seattle. They're looking for like the family orientated. And honestly, Leshi's not falling in that bucket right now. And neither is Capitol Hill, just because we know it's a little bit, it's actually been some of the best market. And now people are like, well, if I'm reloading in, I want to be more family friendly.
Right.
And so that's what I've definitely been feeling too. Cause I'm like, it's just, you know, kind of is what it is. But your showings, yeah, they have increased over the last 2 weeks have been a lot better.
Yeah,
It's
totally. Yeah, I think I'm starting to see it. So yeah, hopefully it results in an offer, but I'm hopeful. I think the price drop is enticing. We may
You're
do
at 530 a foot. That's competitive.
yeah,
Like it's yeah, it's like the West Seattle house I got listed. It's at 650 a foot. I might do a little adjustment to move it, but it's like that's priced where it needs to be. It's just people are being selective. It is a little bizarre right now, but
yeah, no, I feel it, but
part of, part of the good thing is we're through summer, you guys. Summer is always terrible. Doesn't matter what's going on. Like last July was horrible. And everyone kind of forgets about that. That's why you guys timing's a big deal. Like when you're taking your properties to market. Um, and I know like internally with our investment team, like you guys, if we're going and we're not listing in April, May, I want to add more debt time to all deals. So, um, but
got it.
it's good. Bellevue's that's a good little price point right now. Like 1.5 to 1.7 is kind of the sweet spot right there. It, it turned back on. There's definitely little pockets. Redmond 1.6 is 1.7's good. Um, you don't want to be 1.8 to 2.1 though. It's a bad range. So yes, and for anybody who missed that recorded call where I broke down the market and pricing and different range, like what to dig into, you guys, is really important. Because we don't want to have that same mindset of like, well, Capitol Hill's slow. Okay, well, where's it slow? What works, what doesn't work? Because I definitely know each little zip code, each area has price points that move a lot better. And so that's, spending that time, you guys, please listen to that recorded call. It really does. Like, we don't want to go in with the masses of the market's slow. I mean, Alex sold her flip and Florida's supposed to be really, really slow.
Nice.
So it's, the price point's good at where she's at. So congrats, Alex. Did you do that deal?
Thank you. Yeah, we still haven't closed. We're set to close on the 30th. But yeah.
But it's locked in.
Nice.
Yeah, thank you.
That is, you guys, that is awesome. Yeah, I've known Alex now a little while, and watching her through this journey has been really cool.
I'm gonna submit an offer for another property today, like in the same zip code. So we'll see what happens.
There you go.
Yeah.
So just make sure you have a feasibility through when your deal's non-refundable and locked in.
Like enough time, you mean?
Well, you just don't want to because it's not closed until it's closed, so you don't want to get yourself in a pinch.
Yeah. So what do you suggest? Like
How far are you out from closing?
the 30th? So I'm
The
kind of far
30th.
out. Yeah.
Just is your deal through all inspections, all feasibility on?
No, I'm waiting for the appraisal. So that's what I'm really waiting for.
Okay, try to get through all your feasibilities just because you never know, right? And I'm not trying to
Yeah.
spook you either. It's just that condition that all of a sudden, if you do a non-refundable deal, you can put yourself in a little bit of a pinch.
Yeah.
If you're sitting fine with liquidity and you can do it, then move forward. Just don't get too exposed out that way.
No, yeah, I need some time. Okay. Thank you.
Yep. Cool, you guys. Well, I'm gonna pull up our little presentation. We're going to go through it real quick and then we're going to open up. And you guys, this is an important concept I want to talk about. Leverage makes a big deal. And let me get my screen shared. Leverage and terms are, there's a lot of people still loading in. So I might give it just another breather. But what we're talking about right now tonight, you guys, is one thing, when I got started in this business, the first house I ever bought was with 12% money and 4 points. And I'm totally used to expensive money. And it's just a cost of the deal to me. But there's times to use cheaper money and more expensive money. And there's levers to pull and how you want to negotiate and what kind of deals that you're looking at too. Because I see a lot of people fall into that interest rate trap all the time. It's like, oh, well, I got this lender. I'm like, ooh, which lender? And then, they're not really thinking through all the terms or how the deal's set up or what they're negotiating against, or they're really just focused on the interest rate, whereas I'm looking at the total overall deal. I'm always looking at what's the margin on the house. How do I need to set it up, and how do I need to set it up that way? And so we're going to talk about when to use soft money and when to use hard money, because there's a purpose for both. You guys, I just used soft money in Newport Beach. Why? Well, it was a $6 million purchase, and I had 5 months to close it, basically. And so I had all the time in the world. The loan balance is big. It's like a $4 million balance. That's a big monthly expense. And so, if I can pick up a couple percents on my rate, that makes all the sense in the world. Like luxury homes, I typically try to use them on because they're bigger balances, and a lot of times I can get the terms. I bought 2 this week that we'll go over, and I'm going to pull up a form when I'm done. We got deep discounts on these houses because we were closing in 5 days. There was offers for 100 grand more than our offers, but the seller took ours because there was a little bit of a feasibility on there. There were some conditions, and their closes were 21 days to 30 days, whereas, they listed these properties on a Thursday, and I'm signing closing docs today. And so there's a purpose behind that, right? And so when I'm looking at cost of money, if I'm getting $100,000 discount, what do I care if it's an extra percent or two more? And so again, it's all about when you're using those terms and when not. And so sorry, I just got a text about the deal I'm supposed to be closing. So I'm going to pull up this presentation. We're kind of 15 minutes in. People can get caught up. Let me get this up. And you guys, this is an important thing to do. And you guys, no matter what, you should always get pre-qualified for both, right? And you guys, I own a hard money business. So, but there's a time and a place for everything. And, that's when we want to use it. And you guys, I balance money with the deals I'm doing. I just locked up a deal, expensive house in Yarrow Point. It's 3.1 million as the purchase. It's a very, very clean house. The lady wants a 90-day close. That's a good time to use soft money, right? I can get it prepped. I have access. The house isn't too bad of shape. Good time to use it. So, we're going to run through this real quick. I'm going to run you through an example of the deal I just bought and what the deal kind of would look like if I went with different funding. And at the end of the day, a lot of times the math is just the math. And many, many times when I'm offering it close quick, I can get a much, much bigger discount. So hard money versus soft money. So what is the difference? And you guys, I don't even know if soft money is a real term. I just started calling it soft money. Now it seems like a lot of people do. It's, one thing that we've seen, I'm from a world where hard money was around 2000. It's been around since, for like fix and flip, it's like really like late 90s, early 2000s. Back then, you guys, 2000 to 2000, I would say 14, 15, everything was 12% or more, and it was 2 to 4 points. And 2 points got you 6 months, 4 points got you 12. And back then, it was also 20% down, or maybe 15% down, and they didn't do a lot of construction financing either. We have a lot more access to debt nowadays. Back 2008, first deal I bought, it was 20% down. I had come up with the rehab out of pocket, and it was 12% and 4 points. That's just what the terms were. And so there wasn't a lot of different types of financing unless it was conventional or maybe bank financing. The soft money world didn't exist. Where soft money came from is the venture capitalists of the world, Blackstone and all of them, a lot of big banks. They wanted to get in this space. They go, wow, these are great yields for low risk investments, according to them. And, because they have billions of dollars to lend, they're on the scale of lending out more. Volume's a good thing, right? They'd rather lend out more on a smaller spread than they do as like a hard money lender. Now, part of that is they have a lot more conditions on their money because these big venture capitalists and investment companies, they have they have a lot more restrictions because they're getting money from banks and they're really just working and selling off notes, and they have to work with inside their note buyers. And so a lot of times I say soft money lenders have daddy lenders because they're really not making the call. Whoever they're selling their note and they're working with really has the call. There's nothing wrong with that, but it can change the terms of the deal. And so that's how it kind of came about, right? So as hard money lenders, we started seeing these guys pop up 2014, 2015. And, at first it was kind of a concern because they were cheaper, but what we learned is they are two different types of product. And that's what we're breaking down. So soft money, what is their typical rates? It's about 9 to 10.5%, sometimes 11% if you're a newer flipper. Their origination points are typically going to be 1% and 1 to 2% of your loan balance. So that means they're charging you, let's say you have a loan for 300 grand, it's going to be anywhere between 3 and 6,000 for that origination fee. Typically, that's rolled into the loan balance. You then are going to make a monthly payment at whatever the rate is from 9 to 10.5%. So it's a little bit cheaper. Their down payment requirements are usually 10 to 20%. They'll typically give you a pretty big range, and it really depends on the loan to value. They'll make you put less money down if you're getting a better buy. If they feel like it's tighter or their appraisal is a little different, they're going to have you put more money down. And this is important. We're going to explore that. When you purchase with soft money, almost every time you are going to have an appraisal required. So they're not going to appraise the house as is, or they're going to look at the as is value, but the appraiser's going to go out, do their walkthrough on it. They're going to look at your construction budget, and then they're going to put a value based on the scope of work and the construction on the property. There is one issue with this, guys. Appraisers a lot of times don't know construction very well, and they don't know finishes, and they don't know upgrades. And so there is a condition when you're buying with soft money of, hey, if the appraiser that goes out there, it's not someone from the bank, it's a separate appraiser, you're dependent on their value. In whatever value they put on the property, that lender is going to have a minimum and a maximum loan to value. If the appraisal comes in low, your down payment is going up. And that's why you'll see this big range in 10 to 20%. Soft money also does reimbursement draws done by third parties. So typically what this means is, and some of them are moving away from this, I will say, over the last 6 months, because it's kind of a nightmare. But most lenders hire a third party construction company that will come out and do a property walk, and they're going to inspect your property every time you want to get construction financing. So when we purchase these properties, we're getting typically a rehab loan. Both entities do this. They're going to put your down payment is going to be on, let's say, 10% of the purchase price and the rehab amount together. So if you're buying a house for 200 and you are putting in 100, and let's say you have to put in 20% down, you're going to be coming in with $60,000 down. And then these lenders are going to finance you back the construction, that $100,000. Now with soft money, you get reimbursed as you expend the money. So when I go purchase this property with a soft money lender, I'm putting down my $60,000, and then I'm going to start investing more money into the house to get the project moving forward. Once I get it through $25,000 worth of work, I'm going to fill out their form. I'm going to submit it in. They're going to come out. They're going to look at the property. They're going to say, well, we think you did $20,000 worth of work, or $25,000. They send that to the lender. The lender says, this is what it's been approved for. They're going to give you your check. So typically you're putting your down payment down, and then you're going to be coming out of pocket about 25% of your rehab costs throughout the duration of your project until it's completed. So even though sometimes their money is less down, you have to look at what your cash out of pocket for cash flow throughout. Closing time frames. Typically with a soft money lender, it's going to be 10 to 14 days, maybe up to 20 days. So it takes a little bit longer. They got to review your budget, they have to onboard you, and they got to get their appraisal in. It's really conditioned on how quick that appraiser can get out there, how fast they can get that report back, and then they can kind of get into drawing docs. they're typically going to also do a deeper background pre-qual where they're going to want a full credit report. They're going to check your assets. They're going to check your experience level. How many flips have you done? How many assets do you own? What's your liquidity? They're going to dig a lot more deeper into you, very similar to like how a commercial bank would if you're going to get a multifamily loan. Very, very similar pre-qualification process. Sometimes it's even more, you guys. Some of these big lenders that do bigger loans, like you guys, I will say, I have a lender. I use Genesis Capital down in California. I use them because I know the head originator there. Great dude. They have good rates. They're very similar to a commercial bank. The loan I got on Newport Beach was for 9% interest rate on a big balance loan. It was also 1 point for 12 months.
Ya.
Nothing to knock against
Qué
them,
rápido. Voy a
but
darle vuelta así, men.
you guys, it was a nightmare getting pre-qualified with them, even with me. And I've flipped a lot of houses. I have a lot of liquidity I can show. I can show assets. It took me 60 days to get qualified with them. They wanted, and they went through every one of my projects, where it was at, because they're lending money at a cheaper rate and more balances. They're going to be a little bit more thorough. So it's a lot deeper background check, especially for bigger balance loans. Their typical terms are going to be 9 to 12 months. So overall, it's a little bit cheaper money, but there's more conditions, right? There is, when you're buying with a soft money lender, there is, at the end of the day, some conditions to you funding. What is the appraiser coming in at? Do they approve your budget and your rehab amounts? Do they approve all of you and your assets? These are things they're going to dig a lot deeper into. That's why you're getting it for a little bit less money. They are getting less risk in the deal because they get to go through their check boxes and check off their appraisers and values and then be able to bundle it up and sell it off. Hard money is different. This is more instant funding, you guys. This is where your rates are going to be anywhere between 11 and 12%, even sometimes 10.5%. So it's a little bit more money, right? You're going to be paying 1 to 2% more on your interest annually. And their origination points are typically going to be 1 to 2 points. So similar on the origination points, but the rate's a little bit higher. The down payment is going to go anywhere between 10 and 20% down of your total project costs. And that does depend on loan to value. The difference of the loan to value is with hard money, like true hard money, guys, is they don't require appraisers. So in trust funding, when you're working with a soft money lender, that's where they're going to have that third party appraiser come out. They're going to look at that property. What is it? They'll look at your scope of work. They're going to look at the comps. They're going to put a value on it. With true hard money, there is no appraiser. We underwrite everything in-house. It's done by our head underwriter, myself, or my business partner, Will, who runs Point. That's why things can get funded a lot faster. It's not about what an appraiser is. It's done by real estate professionals that can look at it. They understand value add construction, and we can put the value on it. It does make a big difference, not only in how you're looking at a deal, because people who are looking at the property are actually investors themselves, but also you're not paying $1,000 to $1,500 appraiser fee, and you're not having to combat an appraiser that doesn't understand the scope of work. You guys, on my Newport Beach appraiser, and even my other Newport Beach flip, both values came in over $1 million under the appraised. The appraiser came in $1 million under my fixed up value. We had great comps for the value. I feel comfortable in it. We had to go fight with them on that. And then finally and the appraiser wouldn't move his number, and management finally just approved it because of who I was. If I didn't have the experience with them, they were not going to approve it. The appraiser wasn't understanding all the upgrades we were doing. We were installing a $100,000 Control4 system. We were taking this to a different level than the comps that he was referencing. And that's why that's that huge value. If my value came in $1 million less, that can make me have to come up with another 10 to 15% more on my property, which would have been detrimental. And that's the big difference, is hard money is a lot faster. So no appraiser gives me the option or anybody an option to waive conditions on something if the value's there. And that's why they can move a little bit faster. Hard money also does advanced draw processes. So when I come in with that same example, I'm buying the house for 200,000, there's $100,000 in construction reserves. If I got to bring in 20%, that's $60,000 down. The day I close, the hard money lender is going to fund me $25,000 of my rehab on day one, 25%. I then can take that money, spend it, then ask for another construction draw. Most hard money lenders also review all construction draws themselves. They're not sending out a third party. So even though the rate is a little bit higher, I'm not paying an appraiser, and I'm also not paying a construction draw fee every time I'm going out there. And so it starts reducing the cost on the hard money. In addition to it, just makes my life easy. Closing time frame can close within anywhere between 3 and 7 days with hard money because, again, you guys, it's not something that is getting appraised. It's getting packaged off and sold. With hard money, most of the times it's funded by internal funds, like interest funding the company we owned. We have the cash sitting there. We can fund it in 48 hours if we need to. And we do fund plenty of loans where the appraisers come in low and people are scrambling last minute to try to get their deal funded. And so that's really the difference, right? It's the hard money costs about 1% to 2% more, but I get a little bit more access to liquidity. I get my draws up front. In addition to, it allows me to write offers very aggressively to where I can focus on that discount. Now, there is a time and a place, you guys, for both, right? Like that one in Yarrow Point, Newport Beach, cleaner houses that I feel like will appraise well and that I can get the terms and access on, I will explore soft money. If I have something with heavy value add, I'm usually not going to be looking at it. Another thing is, guys, terms for hard money can typically be a little bit less too. So those are things you always want to ask the hard money lender. Hey, can I get a longer term? You say 6 months, can I get 9 months in there? And so a lot of times that's where the cost can come from too on the hard money side. If they write that loan at 6, but the other lender's at 9 to 12, you don't have to pay any points at that check-in. And so those are definitely things to always ask, like what's your terms, what's your rates? So they're very, very similar products, you guys. They just have a little bit more conditions, a little bit cost. So when you're calling and talking to these lenders, you guys, because you'll hear everyone says they're hard money, and that's just not true. I did record a call recently with a guy that called me, and I went through and I was grilling him on his rates and terms, and he was giving me answers that were non-answers. And I was like, well, I need to know this if I'm going to use you. I'm going to need to know this. And he's like, well, no, it's here's the product, typically it's 10% down, but it just depends. I'm like, well, what does that mean? It depends. Like if I'm writing an offer and I'm writing a $50,000 non-refundable earnest money, I can't have it depend. I need to know if it is, I can depend on you funding it. And so, I actually recorded the whole call. And then when we're done, I was like, hey, dude, is it okay if I give this to my community? He's like, absolutely not. He didn't want it out there, but we got to ask these lenders the question, are they hard money or soft, right? Because I also don't want to pay higher rates for something that I'm getting an appraiser for and have to go through more conditions, right? The point of me paying more on the hard money, if I'm going to choose that route, is to have an easier, quicker close with a more aggressive offer. If I'm not getting all those things, then I want to go price these things out. And so the first thing we always want to ask is, you guys, what is their rates, terms, and points? What's their interest rate? What's their origination costs? And then what is the term you can get how long for? The other question we always want to ask you guys, because there's tons of hidden costs in these docs. I will tell you that. I've signed lots of them. What is their closing docs? Do they have a doc prep fee? Do they have an appraisal fee? Do they have a recording fee? Do they have you'll see a list of junk fees on there. Some junk fees can add up to $3,000 to $4,000 per deal. And even though they're advertising maybe a 1-point origination, their junk fees get them right back up to 2. So you want a schedule of what fees do they charge and how much, and then total those up. What is your experience level? And does that change their rates and points? When we get these automated calls, they're coming out and say, hey, we can get you anywhere between rates between 8.5 and 11, or 8.5 and 10.5, or 12. Why is there a range? Oh, well, if we're going to get you below 9%, you got to at least do 20 deals and have $1 million in the bank, right? What are their requirements? What is their experience requirements? Yeah, the more deals you do, the cheaper money will float around. And so, but we don't want to get into that before we're depending on that person to fund the deal. One big mistake I see people make all the time, they're like, hey, I talked to this lender. They said I can do 10% down, this rate, I'm ready for a deal. And then they kind of go through the formal process and they're like, oh, the rate's not 10%, it's 12. And they're not 10% down. They're 20% down because I've only done 3 flips, or I've only done 1 flip. So these are important things to know because it's going to change your terms. Can they guarantee a close time frame? If something happens in my loan, the appraiser, the budget, if this comes up, am I talking to third parties or can I talk to a manager and a decision maker? I always ask that question. Genesis Capital, I like Genesis. I think they're a great lending company. They can be a little difficult sometimes, but at the end of the day, the reason I use them is I know if I go through all their hoops, I can talk to a decision maker to walk through a logical transaction with them. They overrid that appraiser. They got my deal done. I knew that would be the case no matter what with them, and that's why I went with them. So these are important things to know. What happens if the appraiser doesn't come in at value? Do you have to hire another appraiser and eat another $1,000 to $1,500? How long is that going to take? How will that slow my process down? Are you going to increase my down payment amount? What are the things that happen if the value does not come in? And you guys, I will say values don't come in often, especially with the lack of comps that are out there right now. What are their construction draw fees? If you guys are getting a construction loan, what's the fee they charge you every time? I've seen some lenders charge $1,000 per draw. If you get 5, 6 draws, that's expensive. Your typical draw fees, guys, should be pretty nominal. They should be less than $200. If they're not, will they bring those down? Or is it a balance with the points and the rest of the rate, right? And so those are the things we want to consider. What are your minimum and maximum loan amounts? Many of the soft money lenders won't finance deals that are like below 200 grand. It's not worth their time. You want to know that up front. Also, you want to know that if their appraisal's $1,000 and if the loan balance is 200 grand, that's a half point extra on your cost. And so what are their minimums? What are their maximums? I had a lender call me recently. He's like, hey, I saw you did this loan in Newport Beach. You know, I'd love to talk to you about terms. And I'm like, well, like I got this term. And he goes, okay, well, we can do that. We can do that. Oh, we can do better. We can do less down. He starts rattling off stuff. I'm like, okay, well, let me know what you can do. And then he went and talked to his manager. He came back. He's like, oh, no, at that loan balance, we actually need even more money than you put down. And so you guys, based on the loan balances, things change as well. It's not just the deal. It's just not you as the operator. It's how much they can fund because there's restrictions on that. Many of these lenders are pledging these to different lenders and they have maximum loan amounts. And if they can't pledge that whole loan amount, it reduces their power in spending. And so those are things, again, we need to know. What's your minimum? What's your maximum loan amount? What's the experience level that you require? Do you finance new flippers? What if I've done 10 flips? What if I've done 20 flips? What if I've done 500 flips? What does that look like? Do you do an interest reserve? This is key right now, you guys. So I use interest reserves on the regular. The reason I do it is I ain't a deal junkie. I like buying deals. I oftentimes will put more money up front to get an interest reserve because it locks up my capital, so I know I can't spend it, and then my debt's covered. What an interest reserve is where your monthly payments are factored into the balance of the loan. So many times I opt to put more money down up front because the lender is going to give me the construction funds and 6 to 12 months of carry on my deal. It's rolled into the loan just like a construction loan. and then I have to bring down my down payment, and my down payment may go from 15% to 20 or from 10% to 15. So I'm putting more money down up front, but I know I'm covered on my rehab costs and my payments for the next 12 months. You guys, when you're doing a lot of deals, I highly advise that you look for this. It's a really good way to balance your liquidity because the burn rate is real. Like right now, I have 4 properties on market. I'm probably paying 30 grand a month on those houses. That can add up very, very quickly. When I have an interest reserve, I've already spent my money up front, so I'm locked in. You guys, I highly advise, always ask for that. You guys don't be afraid to put more money down up front because it covers you. It makes it less stressful. Less stress means you can make smart operator decisions. Smart operator decisions will yield you more money every time. Do you allow seconds? Many of us use private seconds to fund our deals. There is many soft money. Most soft money lenders, guys, will not allow it. And there's actually a clause in their loan that if you record a second against that property, they can call your whole note due. And they can put you into default. This is important. And you want to make sure that, especially if you're bringing in other money, right? Because if you're bringing in other money, you might want to do a joint venture with them instead of a secondary loan. Or if I'm bringing in a secondary loan, I just make sure my lender's good with it. And that's why I use hard money. Hard money is a little bit more flexible on that side because at least I can tell them up front. And if they know up front, they can talk about it. They can waive that. So it's very important that you guys ask those questions. These answers are going to start to tell you what they are or not. If they got to do an appraisal, do they use third parties for the construction draw? I already know they're soft money. And if their rate's 11% and they're required all these things, I might go with someone else, right? If I got to jump through all these hoops, I want the cheapest possible money. If I'm going to pay more in interest, I want to get the easiest possible. So when to use hard money, when to use soft money? Soft money, I think is great for cleaner houses. If a seller's really dug in and they got a good house and they won't go down to the price that I need them to, that's where we negotiate terms. Well, hey, will you take a longer close? If they'll take a longer close and I can get my debt setup structure different, I can probably pay them more. The savings on the interest rate allows me to pay them a little bit more. This deal that I bought in Yarrow Point, I wanted to pay $3 million for it. She wanted 3.1. She gave me lots of time. I can get in there. I can do my architect plans. I can file for permits and I can get a long close so that it all works inside of what I'm trying to achieve there. If you have property access, soft monies can be good. Many deals I buy, it's one walkthrough and I can't get back in there. If I'm buying a deal from a wholesaler and their contract is set up with no appraisal, all cash, if they assign me that deal, I'm taking on the same terms as what's in that contract. If I go send an appraiser out there, the seller doesn't have to let them in. That's not part of the terms. The wholesaler might not let you in because it's not a part of the terms and how they negotiated their deal. Really important. Oh, and you guys, one thing I forgot about too is when you're buying a wholesaler deal too, another question, I got to add this to this list, is do they finance in assignment fees? Because many deals that we buy, you guys, are off market and the fees can be big. Hard money lenders like an Intrust, a recent deal I did, there was a $200,000 assignment fee on this deal. It was just part of the acquisition. If I bring that to a soft money lender, they don't like that. They want 10 to 15% down on contract price and will pay a little bit of assignment fee up to 3 to 6%. But after that, they want you to come out of pocket with that. That requires me to bring a lot more cash to close that deal. Not going to work if I'm trying to get the highest cash on cash return. So do they finance assignment fees? Do you have property access? If you don't have property access, guys, it's hard to get an appraiser in there. Development plays, longer close deals or deals that I know are going to go for a longer period of time. I want to get the cheapest possible debt if I'm going to be in this deal for 9 to 12, 18 months. And setting that up right, typically when we're negotiating development deals, I'm negotiating a lot longer closes to keep the cost down. properties with feasibilities or inspection timelines. For some reason, that appraiser doesn't come in at value, you can walk from the deal, no risk. If I got inspections, feasibilities, timelines, then I can work with that a little bit more. If I have a no feasibility deal and I lock in, I put down my earnest money of 50 grand, I pay the assignment fee, all these things, and that appraiser comes in 20% too low and they want me to put 35% down and I can't cover that. If I can't close that deal, I'm out my earnest money. That's risky. I've seen plenty of people lose their earnest money because their lender asked for too much money down 24 hours before closing. So again, soft money, cleaner houses. Do they appraise well? Do you have really good sets of comps? Is it a less trickier market? Something to consider. Do you have property access? Do you have a feasibility? Then I'll start looking at those more soft money lenders. Hard money. I would say you guys on 85% of the deals I buy, I use hard money because this is how I negotiate. And this is just me as a person. We like to come in quick close offers. We can write offers to a seller for a 5-day close or a 7-day close or a 10-day close, no feasibility, earnest money released. We feel comfortable in closing that deal because we know the money is going to fund it. Many times, you guys, I'm paying 10 to 15% less than other people would pay because I can close that quick. So if I'm buying a $500,000 property and I can get it 10% cheaper, that's 50 grand less on that property. It is going to 10x the cost of the interest on this. I use hard money when a deal can't be jeopardized. I have to close. I cannot, the deal I'm closing right now, you guys, if I don't close this deal by tomorrow, I'm out 50 grand in earnest money. I cannot wait for an appraiser or wait for someone to come through. Non-refundable earnest money. I always use hard money. If I'm putting up non-refundable money, I want to make sure that there is no jeopardy on that. Deeply discounted, heavy value add properties, I use hard money on. And the reason I do is appraisers don't understand what we're doing most of the time. When they walk into a property and it's dilapidated, or even better yet, the one I went in today, there is so much trash in this property. You can't even get to the upstairs. You try to go through the back door, the whole roof is caved in. You try to go through the front door, you can get there, but you got to climb over 5 feet of garbage just to get to the staircase to go to the basement, that you get to another 5 to 6 feet of garbage in the basement. This is not good for an appraiser. There's no access. It's a heavy fix. They can't really see the spaces. There's no point in me sending an appraiser out there. They're not going to be able to get in. If I'm adding a lot of spaces or reconfiguring, doing a high-end renovation that might get me a huge premium for the property, sometimes the appraiser doesn't understand that as well, just like my Newport Beach examples. Specialty properties. If there's some hidden value on a property that I'm seeing that I snagged a deal on, maybe I can carve off a lot. Maybe I can, add an additional unit. Is there an easement the property owns that I can sell to the neighbor for money and make some extra money on it? An appraiser's not going to take that into value. And so those are reasons I use hard money, is because I can walk that lender through, they understand it, and they'll fund that deal. And then if any kind of private investor seconds are in there, I always use hard money. I want the lender to be okay with it. I don't want it to be a workaround, because at the end of the day, you guys, when I'm taking in private money on a second, it's my responsibility, fiduciary duty, to take care of that lender. If I'm putting them behind a lender that says they have a due and sale clause that can foreclose the property because their deed is there, I'm putting them in very high risk scenario. I do not want to do that. I will happily pay more on my interest rate. And so those are the times of when to use hard money and not. And I know there's a lot of different financing going on, and that's what we're going to kind of explore on tonight's call. But I do want to show you guys something where, let's look at this deal that I'm buying right now, or closing. And you guys, very, very competitive. If anybody was in Seattle market, they probably saw this. It was 399 grand on market. Thing was hammered. It was a property, big lot, lots of trees though, not the best development site, a lot of activity. But hold on, project already flip calc. Well, I'm gonna pull up a different flip calc, but it's all good. So they're all the same thing. So why did I opt for more expensive money on this deal? I did it. Oops. Because it's all math to me. I don't really care. My rate could be 24%. That's just is what it is. It's hard money for me is just the cost of the deal. If I got to buy it in a certain term and have that cost of money, I have to factor that in my deal. If I can get cheaper money, better terms, my price is going to change. So on this property here, sorry guys, I'm trying to share this. There we go. So this property here, you guys, it's worth $1 million. Well, I sold my house right down the street for 1.1. Same type of heavy fixer. We're putting in 300 grand in this house. The options for us was we can get this house for $565,000 if, and you guys, they had over 25, 30 offers on this property. We were definitely not the highest, but the seller wanted a no BS sale. They've been trying to sell it off market forever. A bunch of people tied it up. They wasted their time. They finally brought it to market. And when we called the broker, we said, hey, look, we need to buy this thing. Where do we need to be at? And they go, hey, we have offers in the 6s or above. I go, well, I can't get there. And I go, yeah, well, I'm like, is there a feasibility? And they go, yeah, there's a little bit of a feasibility. They got to check these things out. It's about a 30-day close, especially for the people that were in the 650 to 7 range. Longer closes, feasibilities. And the seller want to guarantee close. And they go, okay, well, when is their feasibility up? And they go, well, the fastest guy will be up in about 7 days to 10 days. And I go, well, what if I close it in 5? So I will close it before they even get done with their feasibility. And they go, they will definitely look at that. And so even though they had offers for 100 grand more, we gave them that 565 offer, close. They went with our offer. And again, we're closing it today or tomorrow. So we're closing early for her too. This is the right here. The profit on this deal is 106,000, 53% cash on cash return. There's also some upside in this deal. Let me make sure the rates. And this is, I'm going to do full max on everything on this. So here's the rate. Oops, this is at this. So on this deal, it's 86,000, but there's also a little benefit. I might be able to carve a Dadu lot off here. That's the kicker in the deal. If I can get the Dadu on there, it's a really good buy. How I got the good buy is I came in with a 5-day inspection. Now this deal works. You know, I didn't waive feasibility thinking I might get the Dadu lot. It was, I'm going to waive feasibility knowing I can flip the house. If I can get the lot around these trees, which I don't know if I can, it becomes a home run deal. If not, it's an average deal. I'm good with it. I'll keep moving forward. I bought it cheap. That's what got it to me for 565. Now, if I was to pay even $640,000, let's say 630, that's $60,000 difference in the purchase price on the property. And again, they had higher offers than that. The rate goes from 12 to, let's say, 10, which would be a fairly good soft money rate. Let's say their points go to 1. The profit is still $50,000 less. And so it's not just about the rate and the term. Even though I'm paying the max rate, the max term, I'm making more money because I got the deal done for what the seller wanted. I focused on what the seller's needs was, get the deepest discount, and I tapped the resources that I knew I needed to bring. Now, in this property, if they're like, hey, they want higher numbers, I then would adjust my offer for feasibility, see if we get something in the backyard. I would do a longer close and set it up with with cheaper money. But that's not how I got the deal or not, right? And so again, don't focus on the interest rate, focus on the net profit. And so when you're exploring offers and you're negotiating, find out what the seller's hot buttons are. What's their needs? You know, a wholesaler, if they have a deal and everyone's fighting over it, I can say, hey, I can make this non-refundable, no inspection. I don't need to go in. When's your contract closing? We'll close it at the end of the month. What if I close it next week? That will get the deal shifted over to me a lot of times. And so because I can offer that term, I can get more deal exposure. So who has been working with hard money, soft money? Who has questions? And let's kind of break this down, you guys. Don't get trapped on the interest rate trap. It's not good for your brain. Focus on profit. That's what we focus on as investors. Oh, Alex, it sounds like Kiavi. Are they more of a soft money lender? Yes. Kiavi, I would classify as a soft money. And you guys, there's different levels of soft money too. Like Kiavi's a little bit more direct to the source, certain a little bit more direct to the source. You know, they have some decent products, you guys. It's, you know, just because I own a hard money company doesn't mean I won't tell people other lenders are good or, you know, one thing I don't like is their salespeople sometimes tell you the wrong things. I had an experience with that with Kiavi, and they told me one thing, and then I got them on the phone. They go, "Oh, that's not what we can do." I go, "Yeah, that's what I thought," because what they were quoting me made no sense. Um, yeah, Eric says merchants. You know, merchants, soft money, they're not bad either. And so they're just all a little bit different, right? But they all have a purpose. And so you guys asking those questions, what's their terms of timeline? Are they the direct source, right? There's a lot of people white labeling money too that will call you and they're just white labeling it and they're trying to sell you it. And they're making a spread, but they have no decision making. And if they don't have any decision making, it makes it really hard to get your deal closed smoothly. All right, Alicia, how are you?
Good. This has been super insightful because I realized that I was using soft money on my last deal, but I just only knew the term hard money. So, but they did the appraisal and all of that, and I didn't even realize it wasn't hard money. I was calling it the wrong thing. But
And what was your rate and points on that?
I feel like I feel like the points was easily a 1. It's been a minute since I looked at it, but I feel like the rate was maybe in the 9 to 10 range.
Yep, that would definitely be there. And
Yeah.
honestly, in your market and the houses you flip, that's not because the last one you did wasn't usually uh that I know Eric just said daddy lender. No, they hate when I say that too. I was on a panel one time and this guy was being real cute with me. He's like, well, this rate, this doesn't make any sense. You're paying that. I'm like, well, who's your daddy lender? Who are you selling your notes to? And he's like, he caught him so far off guard. He's like, I'm like, dude, I know you sell your notes to One Sharp. And so One Sharp has all to say. And so it's, which is true. And One Sharp changes their terms. So sorry, I got distracted by the daddy lender, but
All good. Well,
Uh,
and they also did an appraisal, and came in like literally the day before closing, and I owed like 20,000 more. I'm like, what just happened? Like, and so anyways, it's all very clear now that I was working with a soft money and I didn't know there was a difference. But my question for you was when you were saying that there was a deal you're working with a lady and she wanted the 100,000 more, but she gave you time to get like the permits and that kind of, how do you write that deal? Is it something where, you do like a 3-month close and like you're tied up to get the house and you just push out and in that time period, you say like, I'm going to get the permits set up and like, how do you structure that? I'm just used to doing like normal 20-day closes or 30-day closes without all the extra time.
yeah, that's a great question because time doesn't always get you what you want to on that. And so when we write those deals up, we set up the close for 90 days or sooner, and it's at buyer's election. And so, like, for some reason, if my permits kick out and I'm looking good on funds and I can close that thing early, I might just want to jump on it. So like that deal I did 90 days or sooner because I want to time the market right. And then so the contract's written at 90 days or sooner at buyer's discretion. There's an inspection period and a feasibility period on these contracts too, because I want to make sure everything's coming in. You know, I'm paying them more, so I want to make sure we're budgeted out right. We got to really fine tune our numbers, right? The higher price to her is giving me more time to make sure, like, minimize my risk by going through all my steps.
Right.
And so I'm getting it fully quoted during that time period. I'm going to be ordering the appraiser with the lender right away. And what we also add into the addendum, and you guys, this is important to do, is sellers will all of a sudden get finicky after you sign. And on our addendum, it says seller will grant buyer access to property within 24 hours of notice, of written notice, email, text, or formal letter,
Okay.
which we just email. And they have to give us access or seller goes into default.
Okay.
And so, because we have to have access for our, you know, at that time, I got to get my architect in there. I got it. And then we do say, and then we just on a blank addendum, it's just very, very straightforward. Buyer or seller will participate with any permit requirements or signatures needed from buyer. Which many times you don't have to do, but some cities do kind of want a signature from the actual owner before they'll actually intake your permits. Most won't. They'll be fine with it.
Okay.
And so,
Okay.
yeah, because I don't want some sellers stalling me up and go, well, I gave you access. I'm like, well, I need access whenever I need because, you know, that's why I paid you more money.
Yeah. That's super interesting. It's a really interesting approach because I agree it saves time as you're getting everything set up. You're not sitting there paying interest on the loan with no work going on. So I really like that. Okay.
Yeah. And so I was able to, you guys pay him 100 grand more. That's a lot of money, right? But on that deal, it cuts off at least 1 month of my hold time on there. And then it gets my rate down to, you know, if I'm paying 12% on that loan balance, I'm paying, you know, that's roughly going to be, you know, with my down payment, everything in there, that's about 25 grand a month. So I save about 25 grand for minimum at least a month, and I can hit the ground running. So it's probably going to save me about 45 to 60 days on my project. That's 50 grand alone. The interest rate spread will be a difference of, you see, that's going to be, it saves me, because should be able to get 9 on this one because it's super clean. You know, it saves me roughly, on this deal, it saves me about $50,000 to $60,000 in interest based on the loan size. So by
Okay.
me getting those terms, I actually picked up over 100 grand in value.
Okay.
And then it got her what she wanted, and then it, you know, allows me to structure it right so I can also, it, like, basically what I always tell the sellers too, when they want more, I'm like, you guys were a little bit separated right now. You're at this number, I'm at this number. If I can eliminate some of the junk fees in the middle, instead of paying the city, the lender, all these things, I'm just going to give it to you instead. But you got to give me time.
Right. Yeah.
And it's a very fair way of explaining it to people. And people really do understand it when we're sitting down with people. Like, hey, look, I got to pay this cost anyways. I'd rather just give it to you. The same thing I do with my contractors when I'm like, hey, here's my monthly interest payment. If you get done a month early, I'm going to give this to you.
Yeah. Okay. No, that's super helpful. I just wasn't sure how to even like write it up, but I understand what you're doing with the addendum and access and everything. That's super helpful. Thank you.
Yep. Yeah. So you guys, anything with development too, always get that longer and make sure you have full access. Like, buyer has right to visit property within 24 hours. Buyer will do a feasibility study, bringing out architects, civil engineers, oil tank, has full rights to inspect property fully, in order for a smooth closing. So if we don't have access, we can't verify. So your job is, if you're paying more, is to verify your numbers. And, you know, if we can verify our numbers, the risk goes down.
James, just one question though. I know you said you had like the times for the inspection and stuff. Would you have a clause in there that you could pull out? Like if you did your feasibility and you're like, ooh, that's going to be a lot more than I would have guessed, or something. Like, how do you give yourself an out when it's like 90 days like that?
Well, we got to be fair. So typically, I'll write it up like for like our development sites, we ask for a 20-day feasibility. So we have
Okay.
20 days to walk away from that deal inside the 3 months.
Okay.
This house that I wrote, it was again very competitive. So the one I'm picking up for 3.1, a builder paid 3.3 for a lot down the street,
Okay.
but they didn't want to wait that 9 to 12 months.
Mm-hmm.
90 was her max. And so, you know, and she also was just like, hey, look, I'm willing to sell it to you at this price. I was trying to get it for 3. That was too much. But, you know, so I did do my walkthrough and wave inspection. Now, because it's construction and I know it, I'm like, well, it's going to cost me about this much. I know what I need to do here. What I don't know is how long, it's a very small, expensive city, how long their permit timelines take.
Okay.
And I do have to move some structural walls. So that's why I wanted to get a jump on it.
Got it. Okay. Thanks.
Yep. And you guys, there's always times and places, right? Like, if I'm out buying a lot of deals and I got a lot of construction funds due, I might switch to hard money because I get that advanced draw, right? It keeps me liquidity. It's not just rate, it's you guys, it's term of the deal. How cheap can you get the price? But also what fits inside your liquidity. Most soft money lenders won't do interest reserves. Interest or hard money does. The big soft money guys like Genesis Capital, they will do interest reserves, but they're doing bigger loan balances typically too. They won't do small loan balances. And so these are all questions that we want to consider in when we're picking the money. And so, you know, again, I like to lock in, keep my liquidity balanced. I like to put the interest reserves on things. It keeps me responsible. And so, you know, I typically will even pay a little bit more of my rate because it sets up my business correctly. It's not just the deal.
James, can you explain interest reserves one more time? I know you did it. I don't think I totally understood it.
Yeah, so the interest reserves, you guys, and just, you know, on your guys' flip calc, on the partnership calc, where I'm working on getting this built in so you can hit a button where it'll calc it in. But so let's say, on that example I was talking about where um, I'm buying a deal for 200, putting in 100, I got to bring in 20% down. My loan balance is going to be 240,000, right? 200 plus 100 minus the down payment of 60. So the balance is 240. Inside that 240 is $100,000 in construction funds that are going to be issued to me over the duration. What the lender will also do, what interest will do, is the payment on that loan is $2,400 a month. They will roll 6 months or maybe even 12 on a bigger deal, but 6 months is pretty, usually you can get 6 out of them. At 6 months, they're going to add 2,400 times 6, another 14,400 into the balance of the loan. So now my down payment is going to be 100,000, or the purchase price of 200,000 plus $100,000 in construction funds plus another $15,000 in interest reserves. I'm going to put 20% down of that total amount. So basically my 20% is putting down 20% of my interest reserves and they roll it into the balance. So every month they just deduct it from the balance. Does that make sense?
It does. Yeah, I wrote down all the numbers. I'm going to stare at it.
Yeah, you know what, you guys, I should have just pulled up a calculator as I was doing that. Let me do this. So you can kind of see the math, guys. So on this deal, $200,000 purchase price plus $100,000, we're at 300 grand. If I put down 20%, That's $60,000.
Mm-hmm.
That's a payment of $2,400 a month if I'm paying 12% annual interest for this. Times that by 6, I'm at 14,400. So now my new total project cost is 14,400 plus $100,000 for the renovation plus $200,000 for the purchase. The total project cost is now 315,000, not 300. I'm putting down 0.20, 62,880 instead of 60. And 6 months of payments are now covered.
I gotcha. Okay, so the loan is gonna, I'm following now. That's helpful.
Yeah, it's basically adding your interest payments into your construction holdback. And then you're putting your down payment down based on the total project. So it just increases your total project cost, but you don't have to make a payment for 6 months. And you guys, oftentimes your down payment goes up, not just because the interest reserve, but like many times I'll do 20% down instead of 15%. So I'm still putting money down. It just helps me balance the liquidity out.
Yeah, I'm following.
So it's about the same cash out of pocket. It just keeps handcuffs on me.
Yeah, no, I'm clear. That's helpful. Thank you.
Yep. And you guys always explore that option. I mean, one thing I can definitely tell you from my own personal experience and also being a broker that works with a lot of investors, worst thing you can have is mass stress, especially financial stress on keeping up with your payments when you're selling a house. I've seen people cut price where I'm like, I wouldn't cut price. And they're like, we just need to get this deal done because they just ran out of funds, right? And so a clear head makes you make logical decisions. And so don't be, as you're kind of budgeting for these things, put a little bit more money down if you want that clear head. Nikki.
Hey James, thanks for going through this. It was really helpful. Yeah, my questions are not related to hard money and soft money at this point. The deal which I'm working on in Redmond, I have got some updates, so I thought I'll check with you what should be my next steps and like what do you recommend?
Yep, for sure.
Yeah. Yeah. So at this point, like I did involve architect and like also went to the city as well as did some like title validation as well. So as you know that the property is on private easement and like even though it is on private, the title says that everyone can access um whoever lives on that road. The only thing is city looks for like the permission to keep it as a private and not make as a public and get the permission from the neighbors. That is where the developer is looking the permission. Um so yeah,
Wait,
that is
Nikki, I'm a little lost there. Can
okay.
you, so one step back, did the builder ever tell you what they're doing or why they need it?
No, they never told, but we got to know from their pre-application. But he is not responding unless we plan to sign, and then we can discuss over. I asked like we have few questions, and he said okay, then have a call. But I did not call him because I wanted to be ready in terms of negotiation, what I'm looking for.
Okay.
Yeah, so in right now the situation is they cannot build unless we provide the permission to keep the road private. That is for sure. But now at this point, so when it comes to negotiation, we checked with the civil engineer also, and he said they are bringing in the utility, which is like gonna save you a lot. So getting a stub connection could cost like 10,000 for sewer and water meter is around maybe 5 to 6,000. That's what he told. I don't know the exact cost. And when I asked if I asked more money or like the sidewalk, and he was like, we don't know, but it's your negotiation. But typically when they are getting the utility, they are spending a lot. So I am like not sure. And also the latecomer waiving fee, you can just ask to waive off. So those things are there, but like typically what you have seen people asking and like what should be put. I was waiting for this call to confirm with you before I called these guys.
Okay, so I guess take a couple steps back. So they're saying that you cannot build without this easement on their property.
They cannot they cannot get the permit unless we provide the permission in terms of keeping the road private and not make it as a public road.
Okay, so they really do need this easement.
Yes, they
Okay.
need the easement. They are allowed to use this easement, and but the only thing is, city asks that the neighbors in the nearby properties don't have concern to convert it into a public road. If they are fine keeping it as a private only with 25 feet of private road, then you are allowed. But if the neighbor says no, we want to make it like 50 feet or public road, 55 feet, then it's up to the neighbor because it's like an HOA.
Okay,
So
and is there
everyone.
more than one neighbor that has to sign off on this, or is it just you?
So at this point, we have like 4 or 5 neighbors. He has to get the sign, and
Okay, have you
yeah.
talked to any of those neighbors?
Yeah, so I spoke to one of the neighbor. He owns 2 properties. So basically 3 or 4 neighbors, I would say. So those 2 property, he said like, yeah, I already signed. I don't have any issue. And I am assuming that he has also got the signature from the other 2 neighbors. Because he was saying that once you provide the signature, we will start the civil engineering work.
Okay, so is it a vote or is it unanimous? This has to be done.
No, it has to be a voting kind of thing and like formal agreement where he will be taking our sign and show it to the city.
Okay, so it's a vote, but so what happens if they all sign it and you don't? Can they overrule you?
No, I don't think so. I don't think so because I asked city and like I did not ask like whether majority of voting will work, but he said your vote is also required.
Okay.
Yeah, maybe I will ask
I
this
would
question.
definitely confirm that
Okay.
because you don't want to play hardball and then they just go right over you anyways.
Yeah, that's a good
Um,
question. Yeah.
the second thing is it now makes your property buildable, correct?
Yes.
Okay. And what will that do for your property as far as the architect said you could build there?
Um, so I mean, the stub connection will be required because he will be getting 8-inch pipeline and like from for the sewer and water pipeline as well.
I-
So
And is he providing his offer to you is it to provide that stub?
I did not ask. He is not gonna provide unless I ask, but I haven't asked because I wanted to be clear, like, okay, these are my terms and I'm ready to sign. So when it comes to term, I was thinking like waiving of the latecomer fee and the stub connection. But also one question came in my mind, where would we get this stuff? We don't know where exactly what plan we will build on this lot. So getting the stub connection, whether in the like on the left or the right side, or just take in monetary trade. I don't know. It's very first time.
Okay, so well, I mean, regardless, the sewer's going to have to come down the street, and then they would just stub out to your property line, typically.
Okay. So which side? Or it would be
Well,
like, yeah.
it should come to you because you don't. It would need to stub out because it's going to come down, so they'd have to stub it towards your property line.
Okay. So they will be anyways doing it. That is what we're saying.
Yeah, and then there will be connection fees and those things. So what does it do for your property by having that sewer there? Like, what do the architect says? It goes from what it is now to being able to add how many units?
Yeah, so when I checked with the city utility department, they said 6-inch of sewer stub will help you build 3-4.
Say again?
So if you get 6-inch of sewer pipeline in your lot, you will be able to build 3 to 4 dwellings. He said it should be enough for your lot to build in future.
Okay, so it is going to add value to your property.
Yes.
Okay, so what else needs to be done on that road? Okay, so they got to bring sewer in. Are they paving that road?
I think so they have to, right? Because they are gonna tear down and like get the lines and they have to maintain the road also. So I haven't checked, but I will check obviously that we have to get it in the same shape what it used to be. It's not in very good shape, but once they are done, they have to maintain it also.
Okay, so we don't know what the plan is for the road on this.
Right now, no, but all these things I will put in front of him once I have the clear plan of negotiation.
Yes, yeah, and I just really want you to confirm too that they can't like supersede you by holding out. Um, and did you ask any of the neighbors if they asked for anything, or they're just happy to get sewer ran through?
So the one neighbor with whom I asked, he holds another lot, and I am not sure what he's thinking, but he might plan to sell that lot to him as well. So I don't know at this point, but if he does that, then definitely he will be, or he says that he might run the daycare there. So he's like giving favor to him, and he did not ask any questions.
Oh,
He
well,
was like,
he's probably getting a much higher price for his property though, if it's
yeah,
buildable. So, I mean, he's motivated.
he's motivated,
And then what
right?
about the other neighbors?
I actually did not get a chance. Maybe I can connect with them, but I
Okay.
feel that they might not have asked anything because they are old people and they don't care, I think. But I'll confirm with them. Maybe just don't
Um,
know.
a lot of older people don't want a bunch of development going in.
Right, right.
So, I would find out what agreement they said. And when you talked to him, did you ask him like, did the guy give you a plan of what he's trying to do?
So I did not get a chance to connect with him. I mean, I know the plan. He's just planning to short plat and build two, as per his pre-application, build
Okay.
two big, yeah, single family and two dadul, so four dwellings. But he may change it later because it's just a pre-application. But he's
When was the
thinking that,
when was the
yeah,
last time
2-3
he
months, like 3 months back only, his
and he hasn't
pre-application.
tried contacting you for 3 months?
Yeah, actually, 2 to 3 months he did not contact.
Huh.
And I only connected initially with him, not him, but the listing agent. You remember last time when we spoke, you said, Nick, you have to check with the listing agent what they plan. And I initiated the call, and then she told me that connect with this person. And then later on, I found out, like from the city website, Project Viewer, that they have actually submitted the pre-application, which has been approved.
Well, it's a
So
little weird
yeah,
he's spending money when he doesn't know if he can get it or not. That's what's a little weird to me.
yeah.
And
And
so,
his message was like, if you wanted to take advantage of us moving forward, you will just sign it sooner. Some that kind of message he posted in
well,
my text.
and he's not right. I mean, it is increasing the value of your property, right? So we want to negotiate, but we don't want to jeopardize that.
Yeah, that is true.
And so,
So that's where I'm very much in like taking a calculative risk, because if he does not bring the utilities, then our lot value is like nothing. So
yeah,
he
and so
cannot.
it is a benefit, right? We want to play
Yeah,
nice. We just want,
yeah,
from the kind of conversation me and you had, he wasn't really being transparent.
yeah.
And so it's like, well, we're just trying to figure, and I think that's important when you communicate with them. Be like, hey, just like, I want to be neighborly. I want to work on this with you, but I just need to kind of know what's going on a little bit.
Mm-hmm.
Um, I think it could be a benefit, but I have some questions. My questions are you going to stub out to my property?
Mm-hmm.
Second is, what are you doing with that street? Are you improving it? Who has the cost of the street improvements? Because that can be very expensive.
Mm-hmm.
And is there requirements from the city to put in street improvements?
Okay. Actually, I checked with the city, I remember, and the utilities department said that we will make sure that he does the basic leveling up of the road and all. But yeah, I'll double confirm with this guy.
But if he's building some expensive homes, no one wants to drive on a dirt road into there.
Right. Yeah.
Like that is terrible for resale. It's going to cost him hundreds of thousands of dollars.
Mm-hmm.
And
Yeah.
so, I mean, just many buyers spending that kind of money are not going on that road.
Right.
And
Yes.
so, I just say, hey, what are you going to do about the street? Obviously, you're building 2 nice houses.
Mm-hmm.
Like, what's the plan there?
Okay.
Um, and that's totally reasonable for you to ask.
Mm-hmm.
And I mean, at the end of the day, what we want to do is verify, how does this improve? Does it also limit your density at all?
I did ask this question to the city, like keeping it a road private does limit our potential to develop in future.
Okay.
Then,
So it is in your
yeah,
best interest to get this deal done.
yes, and the city said like initially they told yeah 16, 17 something like that, but they confirmed with their supervisor and they said no, it should be fine. So we were like okay, then yeah.
Okay. So at the end of the day, this is a good thing for you.
Yeah, yes, yes.
Um,
So yeah, I mean,
which,
asking.
oh yeah, just trying to, so we still got to discover more. Like, what's your plan? I mean, because what the benefit to you would be like if he puts a good street in and you stub out. Those are 2 big benefits.
Mm-hmm.
Would I not do that deal otherwise? No, I'd still probably sign the agreement.
Yeah, and sidewalk is not gonna make it in front of our lot. So there will be like a 6 feet of sidewalk, which will include like the pavement and like plantation and all. Ours will be a very basic sidewalk and just a 25 feet of road width. And for him, it will be 35 feet. So that was one aspect we were thinking, but we were like, oh, that he has to spend a lot of money and he might, I don't know what he will say. So
Yeah,
yeah,
well, and that's the thing. We can always ask and ask in a nice way and see what he
okay.
says. Hey, so
Mm-hmm.
just questions. If I sign this agreement, will you put in sidewalks and stub my sewer? And what are we doing with the road?
Mm-hmm.
And the worst thing
Okay.
he could say is no.
Yeah, we will just say.
Um, one thing if I was you,
Mm-hmm.
and I do know someone at Murray Franklin, if you want me to send the address to him, is sometimes it helps to send it to a builder that will get you a number on your property
Mm-hmm.
based on certain closing conditions. They're going to run their own feasibility and spend the money for you,
Mm-hmm.
as long as their numbers aligned, right? Like somewhere in that range. Because a lot of times in their feasibility, they're going to say, hey, we have to put in this much sidewalk space. We have to do this. This could be $250,000.
Oh, okay.
Sidewalks and those things can be you guys, when you're developing, especially if you're on
Uh-huh.
a corner, corners are developer killer. They're great because you get density, but the improvements can be brutal.
Oh my God. Okay.
So corners are like a pro and a con,
Okay.
depending on what you're building. If I'm building dadoos, it's good because I get access or density. I get access from 2 sides. If it's a big single family, it's a very negative thing
Okay.
because
Oh.
I have to usually do sidewalks on all sides, which that is very expensive.
Mm-hmm. Okay.
And you guys, those are the things we always want to look out for in development: utilities, requirements, improvement requirements. Those things can cost hundreds of thousands of dollars, if not more. Like a sewer main extension could be 400 grand in Seattle.
Oh my God. Okay. How to get the cost? Like I tried reaching out to civil engineer and he was like, he doesn't know the cost. You have to connect with the contractor.
Yeah,
But
you have
then
to bid it.
yeah, but then in general, because I don't know who actually does this. I know GCs, but they not every GC will do this, right?
Well, that's a builder. Like, typically your dirt work and your concrete guys are going to do it, or when you're hiring is because like if you go build out houses, you're not going to build it yourself.
Mm-hmm.
You're going to typically hire a builder. The builder's going to bid that all in.
Okay. Okay.
But that's
So,
where, like if I had a piece of land like that, because one thing I do know is it's beating you up for a couple $1,000 a month, right?
mm-hmm.
If you can get a number on it from a big builder that goes, hey, if this is happening here, I can pay you this much. If the number's a big return for you, then it makes sense to get out of that $2,000 payment and go buy something else anyways. if worst case scenario, you're selling it for a number that you're happy with, they come do the feasibility, they uncover 300 grand worth of work, and they're going, whoa, we can't pay this much. Then you know what you can try to negotiate anyways.
Okay. Let's say if we want to execute this deal, what should be our way forward? Like, shall we, I know demolishing and building 3-4 will take a lot of initial initial down payment. But if let's say if we plan to build cottage in behind, like a Dadu and all, still the refinancing later and make the negative debt on, just fill the negative debt, something like that. I'm still not clear if this is a good idea, but this is where our confusion is.
Well, so that's where you have to you need to go interview builders to build for you though, because
Okay.
you can't run those numbers unless you know what your build costs are. Like in Seattle, we know we can build at, our true build costs out the door is about 325 to 330 a foot. If it's townhomes, it's about 350 a foot, but that includes plans, permits, dirt work, everything out the door. So
Okay.
when we look at a deal, we can run that number, right? But if we're hiring a builder, maybe it's 400 a foot,
Got it. Got it.
or
Mm.
maybe the builder's 275 a foot. But so you have to have that number to be
Mhm.
able to calculate the actual cash flow.
Okay.
And to
Got
be
it.
perfectly honest, guys, building for cash flow on big projects, not a great idea. Like
Uh,
building a dadu in the back is very systematic. You can hire a builder, it's 350, you can run your numbers that way. Because what's going to happen is your cash flow, even if you're making $5,000 a month when you're all done, $6,000 a month, which I don't
Mm.
even think you will, right? Because you're gonna have so much equity there. You want to sell it and then repurpose that equity into a 1031 exchange.
Mhm.
You're going to be sitting on that property for 3 years building this property.
Right.
So your negative's going to be really big. And
Correct.
so even if you keep it and you're making $5,000 a month, it's going to take you 3 to 4 years just to break even on the cash you have in.
Yeah. That's where this is really
I would highly advise not to build rentals there. You want to, that's not a market to build rentals in. You build a resale.
but then the appreciation will be good, right? Like if we keep the property, even the new build, like maybe build 3, 4 and 2 sell and 2 keep. So those kind
That
of
is,
things.
honestly, I just don't think that's a strategy that makes sense,
Okay.
because you have to look at what your cash flow is. It's
Mm-hmm.
you're like, what size houses can you build there?
I think 4,000 square feet of 3-tier.
Okay, so each one of those houses,
Mm-hmm.
4,000 square feet, it's going to cost you $1 million to build each one of those houses, if not $1.2 million.
Yeah.
No
That's
matter
right.
what, you're not cash flowing that. You would have to have a
Right.
balance. You'd be in the same, you would just have the same situation you have now times 3 houses. So you'd be losing $6,000 a month. You have a bunch of equity there.
Mm-hmm.
You don't build in the east side to cash flow. You can take that property though, and
Mm-hmm.
let's say, what'd you pay for that thing from the wholesaler?
I maybe 100K more of it. That's what you're saying, like for wholesaler?
How much?
So you said like wholesaler, how much
No,
assignment fee?
what was the purchase price on the property?
1.56.
Okay, so 1.56 million.
Yes.
Let's say you can sell that for 600,000 a lot
Mm-hmm.
raw, and they're going to go through it all. So 600,000 a lot, and I don't know. That's what the builder will give you the number on, but that's 2.4, right? So you can make 400 to 600,000 on this property, roughly.
Mm-hmm.
If you take that 600,000, you do a 1031 exchange, and you go buy a 4-unit building in Ballard with a big backyard that you can put townhomes in later,
Mm-hmm.
and you're putting down 600,000 on
Mm-hmm.
there.
Okay. Cash flow.
Your cash flow is going to be $3,000 to $4,000 a month positive, and you
Mm-hmm.
can still develop that site later, right? Just because you
Yeah.
can develop this doesn't
Mm-hmm.
mean it's a good thing to hold. What you want to do is take the development, maximize the equity, sell it, 1031 it, and then reload it into a different rental property that's not going to suck out $2,000 a month.
Got it.
And there's so
Okay.
much dirt you guys can develop, especially in Seattle with the upzoning.
Okay.
And the East Side build, you guys, East Side rentals, it's rich guy real estate.
Yeah.
Like I don't own rentals in the East Side I would love to, but they don't make any sense.
They don't make
I'll buy
sense.
a rental in the East Side if I want to create a bunch of equity, and then I'm usually going to keep it for 1 to 2 years, 1031 it, take that equity and go buy more units with it.
Okay. Yeah, makes sense. Yeah.
I'm just telling you right now, your best interest on this is to work this deal for the scenario you told me when you first joined the group. Figure out how to maximize this deal to where it's sellable. See if a
Mm-hmm.
builder will pay a lot, sell it. Then you're
Okay.
making a lot of money and then reloan it elsewhere.
Okay. So when you say pay a lot, like after short platting, you are saying just sell it to builders, something like that you are saying, or
Or just see if the builder will do it all for you.
oh, okay, okay,
Like because like bigger builders, they'll come give you an offer and they say, hey, you have to wait a year, but I'm gonna
mm-hmm.
do the short plat, I'm gonna do these things, I'm gonna handle the whole thing, I'm gonna run the feasibility. You don't have to worry about any of that.
Okay,
And what you want to do is just get the number. If it's
okay.
1.9 million, that doesn't work for you. If it's
No,
2.5, maybe that works really well, but you don't know until you know the number.
right,
In the
right.
worst case scenario, they spend $5,000 to $10,000 on the feasibility and they walk from it, and you know why they walked from it, and then it tells you what your property's worth.
Okay. So they will be taking our 5 to 10K because they are doing the feasibility for it.
They would do it.
So you are saying 5 to 10K they will be spending for doing their feasibility.
Oh, minimum. That's just to get you through. Can you build there or not? But to do your
Okay.
plans, permits, and everything, and dirt
Mm-hmm.
work, you'll by the time you go to get permits, you'll be into that 150 grand.
Okay, okay, makes sense. Yeah. Okay, and in terms of I will maybe connect with the builders as you recommended. But in general, to talk with this developer guy, only think 3 questions as you suggested, like sidewalk, street improvement, and getting the stuff. That should be our starting, right?
Yeah,
The
just find out. Be like, hey, so are you willing to do this? Because if he's willing to pay for the road, stub it out, that will make a difference for what the builder will pay you, anyways. I mean, what you have a great opportunity to make this into a development site and sell it. That's what I would do if I was you. I would not build this for your first project. You
okay,
you want to the people that buy in the east side these kind of plats know how to buy correctly and they know how to build correctly, and they typically every time I've seen someone keep the lot and build it themselves, they end up making less money
got it, got it. Okay, yeah,
because
I
it's just because the learning curve's so high when you develop,
okay,
especially when you're doing a short plat. There's way more cost in there. If it's a 1-for-1 where you're tearing it down, building, a little simpler. But I mean, this is a pretty complex project.
yes, this is pretty complex. That's true.
And so let
Yeah.
people that know how to do it just get you an offer. And then if the number
Mm-hmm.
works, if the number doesn't work, then we go back to the drawing board.
Got it. Got it. And one more question is if let's say a person, let's say if we have just trying to understand, like we know that people do 1031 exchange on rental investment, but when people own property which has like good capital equity built in long time, how would and they plan to sell the property, how would they reduce the tax? Like, I as a couple, if you own and live there for 2 years, then 500K gain is still allowed. But like after 500K, how do they just trying to understand it?
Well, that 1031 exchange, you defer 100% of the taxes.
Yes, but that's for rental. But let's say if you are having a primary property,
Yep.
and then you have gained more than 500K. So for up to 500K, you know that it will be fine. But more than 500K, you have to anyways pay tax, right?
Correct.
Yeah, there is no loophole
I
after
mean, the
that.
500 grand is a pretty good loophole in itself.
Yeah, no, that's true. Makes sense.
Trump
Okay.
is talking about increasing that though.
Okay. Got it.
So if he gets what he wants, it could go to higher.
Yeah, because one of our friend actually owns the property, and he was just like, we were having some discussion, and he was just saying like, this is what he is currently facing. He has got a good equity, and so I thought I just understand how does that work.
Yeah,
Okay.
it's you just pay the tax. I mean, at that point,
Yeah.
unfortunately, that it's a good loophole, but there's no way to avoid that around there. I mean, you can always lie and put more expenses on the property. That's the only loophole it is.
But yeah, thank you so much. I
Yep.
will do what has been suggested.
Cool. Well, those are all good news for you though.
Yep.
So, Priti,
Hey James, how are you?
good. How are you?
I'm okay. I have two questions on hard money versus soft money, and then some other questions. Uh, is there any difference in hard money versus soft money on whether they lend to personal name or LLCs or something?
It's, I know hard money definitely lends to LLCs. Oh, you guys, one other thing I didn't talk about with that too. Like if you're ever doing a 1031 exchange reverse, hard money's a lot. Don't use soft money. It's not a non-option. You got to use hard money. Because they have to finance your 1031 exchanger. But the reason I brought that up is the LLC or not. Some soft money will only do it in a name, your personal name too. Hard
Okay.
money will almost always do LLC or name. But regardless, they're all going to want a personal guarantee.
Okay, I was just wondering that because I was actually seriously considering the live and flip thing for the next one. So I was just wondering if there's like usually preferable to use hard or soft money for that.
Well, you're gonna need you won't be able to use hard money for a live-in
Mm-hmm.
if you're saying you're living there because that's predatory lending a lot of times. So what you have to do is you want to go to a hard money or soft money lend. They have to have a consumer's lender's license though.
Consumer's lender's license.
Yeah, so they're going to be often like they'll have a mortgage division too. Like we can't lend money to someone moving in to a property. A small percentage of these companies have consumer lending licenses.
Okay. Is that true even if you're not living in the property while renovating it and then you're gonna try to refinance it into a primary loan?
As long as you're saying that you're not moving into it, you can get the loan, no problem.
Okay.
And there's nothing there's in the reality that's happened before, right? People buy a flip, they fall in love with it, they move into it, and they refi it. So that does happen.
Mm-hmm.
And so I would say, I wouldn't call it a live and flip until you refi it out.
Okay.
It'll be much easier on the financing.
Okay. But in that case, do you still have to buy it in your personal name or can you buy
Yeah,
it?
you want to put it in your personal name though. If it's in an LLC, it's going to be trickier to refi,
Okay.
or you're going to need to quit claim that LLC into your personal name and then refinance it.
Okay.
Yeah, the owner and honestly, for your tax return, I would just put it in your own name because if it shows in an LLC, that's kind of a business purpose, so they're going to have problems counting those days, and you want to count those days you're renovating it.
Okay.
And so I would just do your own name.
Okay. That sounds good. The other thing I wanted to ask is, when you do purchase price plus construction loan financing, like, do all lenders ask for the down payment for the construction portion also upfront? So, like, when I got financing for this house, basically, like the lender asked me to put 15% down from the purchase price plus the renovation budget. Is that always true? Because that kind of threw my numbers off a little bit initially, because I was assuming that purchase price 15% is gonna be part of the down payment. The rest 15% for the actual renovation cost would just be me covering that money out of pocket and not actually go into the down payment.
I'm not follow. Oh, can you hold on? Let me use the restroom real quick. Sorry, guys. I went from driving around, hopping on. Give me 2 seconds, but I got a little lost on that question. So
Okay,
um,
I'll
hang tight
repeat
real
it
quick.
when you come back. Yeah.
All right, Priti. So your question was the lender required 15% down.
James, Nicole said she's been in the waiting room for a bit. Could you let her in?
She's not in the right waiting room. She's not in the waiting room.
Really? Okay, then she must be in the wrong call. I'll let her know. Sorry for interrupting.
Yeah, because she did pop on at one point, and I approved her. And there's nobody waiting right now. She definitely was on at one point though.
Yeah, she accidentally dropped, but I'll send her the call link. Sorry about that.
Oh no, all good, yeah. And I'll definitely be watching for her. So Priti, your question was, it was 15%. The lender said you'd have to put down 15% of the total project, so your purchase price and rehab, right?
Correct. Yeah.
So, and then what happened on your loan?
No, I was asking, like, do lenders usually, like, when you say putting down 15%, like, is it always like upfront down payment on even the renovation part? Or is it just the purchase price is going into the down payment and not the renovation 15%?
They're typically the whole project cost is what they're running that as. And there's also different types of lending programs too, where maybe you put 10% down on your purchase price and then you fund the rehab out of pocket. Some lenders will call you up and it will be an option, but then there's a million contingencies on it where they'll say, hey, we're 15% down and 100% of rehab. Some lenders will say that. Very rarely do those loans fund because their loan to value requirements is so low that your deal is usually above that. But every lender I do does not fund 100% of the construction out of pocket, typically.
Okay. I mean, yeah, like not funding 100% is fine. I was just like, this was weird to me that they were asking for that portion of the money also as down payment, because I'm like, why are they involved in the 15% down of the renovation cost?
Well, because they're lending you the rehab money.
Okay.
And so when they're lending you money, their balance of their loan goes higher, right? Which gives them more risk. The higher the loan balance, the more risk that lender has. So the reason they want the 15% down now is it brings down their loan because they're still holding back those construction costs.
Okay.
And so, because it's just the terms are 15% of the total project. So yeah, they want it down now because they're banking in that money for you.
Okay. Yeah, I did not know that. So I ran my numbers very differently. And then when I was closing, I was like, oh, I have to pay a bigger down payment than I was
Well, did they
expecting.
change the terms on you though? Did they say
No, they
15%?
didn't
Okay.
change it. I just had a different expectation. That's why I was clearing that. Like, is that only this lender or every lender does that? Because next time I want to be prepared for
That
how much I have to put down.
That's a majority of lenders. Like I've actually had Kiabe, and you guys, I think Kiabe is a pretty good lender, by the way. But their salesperson called me, goes, "Hey, with your experience, you can do 10, we'll do 10% down and 100% out of rehab, out of pocket, right? Kind of the terms you're talking about."
Yeah.
When I started grilling them on the requirements for that, it was like a 60% loan to value. And it had to be below a certain loan amount. There were so many conditions that it basically would be like this magical deal I could get that term on. And so lenders will say that sometimes, but that's where we just want to drill in and go, hey, so tell me about that program. So I need to bring in 15% down. You're going to fund 100% of the rehab out of pocket or in the loan. What is your max loan to value? What is the requirements to get that loan funded? Because the reason we want to know loan to value is because if their appraiser even comes in a little low or at value, but you're at like at 74%, they're still not going to be able to do that loan. They're going to have you bring more money in. And so someone quotes me and says 70%, that could be doable. If it's 60%, I know that's not happening.
Mm.
And so you guys, that's what we want to be careful of is when people quote us those terms that we want to verify those terms and just ask those questions.
Okay. Okay. These are different questions now.
That's okay.
Yeah. So is it a good idea to calculate like the ARV or the purchase price based on the seller's net after concessions on comps, or only look at the sale price, don't care about the concessions that they gave?
No concessions. I would definitely look at. I wouldn't look at their broker, but if they're paying 3% closing costs, I would put that in my pro forma as a closing cost anticipated. And usually there's a trend. And so, like certain price points in certain markets, maybe they ask for closing costs quite often. Or back in 2009 and 10 when Obama had that first time home buying program, we always paid closing costs. So we basically factored in $7,500 for closing costs on every house, plus the additional fees. And so if you have that information, that's really good information. You definitely want to consider it.
No, so this why I was asking that was for the purchase price, or sorry, for the sale price of this house. Like my realtor was actually like he sent me a whole calculation of how he came up with a certain number, but he was actually using the seller's net from the other properties that he found from MLS and not the actual sale price.
Okay. And so typically, how much were they paying in closing costs?
Yeah, so like one of them had like 5 grand in concessions, the other one had 10 grand in concessions. But obviously we don't know if that was like closing cost or there was some issues in inspection or what, like we don't have that information.
Yeah. And if I was the broker, I'd call them and see. Because if it was credit on the inspection, then I wouldn't calculate that. If it's closing costs and I see a trend, I'm definitely going to take those two and blend them together and go, okay, I might have $7,000 in cost.
Okay, but
Because
that will,
the closing cost is more so they can actually qualify to buy the house. The concessions could be just for work that you've already put into the house.
okay. But even in that case, like the purchase price or the sale price should basically be based off of the comps of the other sale price, right? Even if
Correct.
yeah.
Yeah, you would use on my profit calc, I would look at the closing costs, but the sale price will still be the same. So if it sells for 500 grand and they have $10,000 in concession, I'm still going to use the value at 500 grand. I just
Okay.
might build in more selling costs as I put it in my performa.
Okay, yeah, that's what he is using, like 490 in that case for calculating the actual sale price of my house.
No, he should use the listed sale price as the net, and then if he gives you a seller proceeds, what he
Mhm.
should do is run a seller proceeds with no closing costs, and then run you one with closing costs, so you can look at those and go, hey, and saying, and he did a good job researching that information, and then just
Mhm.
going, hey, look, here's a scenario that could happen because the closing costs are a common trend in this price point.
Yeah, which makes sense because now you have that buffer in there to pay the same amount of closing costs if need be. But the way that he was calculating it, I'm like, I don't have any buffer left. It's from my sale price itself to give any closing costs because now we are calculating our sale price based off of other people's concessions.
Yes, so yeah, you should be calculating on that gross sales price.
Okay, that makes sense. Uh, okay, one last question. So the roof on this house is from 2016, but initially I had it inspected and the person said it was all good. And now I actually sent another person just to make sure that I can get some paperwork on that to see that it is actually good. And they showed me a bunch of pictures with like hail damage and everything on the roof. So I'm trying to figure out whether I should get it fixed beforehand or use that as like something that comes up in the inspection or something and then do it at that point.
Is the roof looks decent right now?
Yeah, I mean, there's no leak or anything as of now. From just looking at it, it looks okay. But like when somebody's actually going there and inspecting it properly, there's hail damage on it.
Okay. Yeah, because you got heavy types of seasons out there.
Yeah.
Do all the houses have new roofs? Actually, I don't think they did when we looked at them.
Yeah, I don't really think
Then
they
I would
do.
leave it and just negotiate it.
Okay.
Especially in this market. Like I was just walking, doing a deal with Dave Myers right now, and the furnaces are like 12 years old. And I'm like, they're in really good shape. They've been serviced. Let's just leave it and we'll see if we negotiate it out. Um, I would if it's working, it looks good. I mean, if it looks really dated, then I might do it just for curb appeal too. But if it's not really a concern, it looks pretty good, but the winters just kind of wore on it, then I would just kind of, because if it was put on in 2017, it should
Yeah,
have plenty of life
2016.
left.
Yeah, it is a 2016 roof. I have paperwork for it actually from the seller.
You know what? I'd leave it for now. I mean, that roof has got to have at least 10, 20 years in it. Is there any warranty on that roof?
No, there is no warranty
Okay.
on paperwork here.
And I would at least have that, and I probably would hold off and negotiate that out when I'm selling.
Okay. Yeah. Actually, I have the same exact question for the water heater also. I think that is about the same time frame, but obviously water heaters life is like 10 years usually.
But it's from 2017.
I think it's from like 2016 too.
Oh, I'd leave it. You got 1 year left. I wouldn't replace it unless it needs to be. I mean, if it's like around that, 10, 11, 12 mark, I'm like, oh man, this is, and it looks a little bad, but if it looks fine, I'd leave it. Because, maybe they want the roof and or they want, because when I'm selling that, like, okay, roof's only 10 years old. Why don't I give you half the credit of a roof and I'll replace the water tank? So it's a way for me to negotiate too.
Mhm.
But if it's working good and it's not past its shelf life of 10 years, I would definitely leave it alone.
Okay. Sounds good. Thank you.
Yep, for sure. We have Sandra, then Lynn. And then, hey, just, I still don't see Nicole in the waiting room.
Yeah, she said that the call link isn't working for some reason, but
That's weird because she was on it
I know she dropped off by accident.
and now it won't work for her.
Yeah, that's what she said.
Weird. That I don't even know how that's possible. Did she try like just restarting her computer or something?
She's definitely joining from her phone. She's in the airport.
Okay. I wonder if it also could be the airport Wi-Fi blocking it. I've had that happen before. Um, yeah, weird. I'm actually gonna try something real quick. Um, so I'm gonna have actually, so Sandra, then Lynn, then Alex. I'm gonna try joining from my phone at the same time and see if that works. Okay. Sandra, how are you?
Hola, James, ¿cómo estás?
I'm good. How are you?
I'm fine.
We
Um,
haven't seen you on the call in a couple weeks.
yeah, I was last week, I was, and the other week, I cannot remember what I was doing. Completely forgot about it. Look, I have a question for you.
Yeah.
Well, first I have to look at the video again because I not completely follow the soft and the harmony. I know the harmony, but I wasn't sure about the software. I review. Um, and the other one, I have another question is, I have two projects that I want to start, but I want to know your advice. I have a house, old house. They want 160. I need 80 to rehab, and the plus in this house is have a lot extra lot. The right now I can sell it for 45. The sale of that property, the house can be between as the rest of the market right now, I think 315, maybe in the highest 290 to 320, 315. I don't have like clear number in that. And the other one, I have the lot, the came building a house, a small house, uh 1,500 square foot. I can build it for 160, but I need to put the lot cost me 25. I need to put 20,000 down plus 10,000 in permits, plans, and use the plans and the permits.
Okay.
So, and that one can be sold for maybe 290. I think that we can push a little bit, but the market here is not like not hot.
It's not hot in too many places right now.
So a lot of they build in cheaper houses, small houses, and the neighbor they are like is they kind of started homes. So they sell them for 285, 290, but that's very cheap construction, and I don't really like to do that. So, but I mean, it's good at the market support.
Okay, so how much? So you can get the lot for how much again? Or how much
Well,
is the?
the new construction, the lot we paid 25, like
Tw-
like
okay,
4 years ago, 6 years ago. So right now maybe we can sell it for 40, but nobody buy lots right now because no, they're not building right now.
yeah.
So we bought it for 25. We can build in the house 1,500 square foot for 160. We need to put 20,000. We need to bring 20,000 to the closing plus 10,000 in permits and plans. I think I need the 8% is the interest right now in this thing.
Okay.
And the soul or the project, maybe we can sell it for 285 to 315.
Okay, so you said the interest rate 8%.
Mm-hmm.
So that's a bank financing, right?
Yes.
Yep. Okay.
Mm-hmm.
And
It's
then
a credit unit, a small credit unit.
the 160 it's plus the plans, right? Plus
Mhm.
so it's like 185 to build that, is that right?
Well, yeah, 185 plus the 10 that happen permits and plans. So 190 flat,
I thought it was
195.
165 to build plus 10,000 plus permits.
Okay. No, it's 160.
160. Okay, so you're about
Mhm.
185 all in with the plans and built and permits.
No, plus $10,000 in plans and permits.
Okay, so 170.
No. Well, I'm sorry. Look, it's 162 building and 25 for the lot.
Okay, I got that part.
Okay. And 10,000 in plans and permits.
Okay.
And well, actually, that's because I think I wasn't making a lot of money because I never put my how do you call the soft costs, like the carrying costs, the insurance, the interest, the all that things that coming with the with the construction.
Got it. And I have that in here for
So
you.
how do you what percentage you put it under?
Typically for the soft costs
Mm-hmm.
on a deal
Mm-hmm.
outside with your soft costs are typically going to be about 2% of your sale price, roughly.
2%?
Yeah, about 2%, roughly, because your carry cost, utilities, insurance on that, your insurance on that build's probably going to be what? Probably like insurance is a little higher in New Orleans, right?
Oh my goodness. Well, to build it is only like I just pay for the duplex $800. That's the how do you risk builder or builder risk.
Yeah, 200 a
And
month.
I pay just one payment for a year. It's $800.
Oh man, your costs are a lot cheaper than mine. I
Boy,
paid
that's to
5,000 for a flip.
okay. Look,
Uh,
but that's to builder. But when I'm finished, they hit me with 1,700 for float and 4,000 or 45 for homeowner.
oh, okay, got it. Okay, so your other costs in there are about another 45. So you're roughly with staging everything. Do you stage your houses when you sell or no?
No,
Okay.
I would like to do it, but I don't want to invest the money in that.
Hey, you know what? I don't know if they do all the time in New Orleans.
No,
Each
no,
market's different.
yeah, no. I mean, I don't think so. The market support that because, like, like I say, I never put the soft cost in this, so I don't know what number I'm looking right now. Like, I need to build them because I need the money, and my husband is, like he say, I'm tired of cottage yard and all those freaking lots.
Well, I mean, I will say the profit looks there. So if you're paying 25, 170, and you guys, this is the same calculator we use at Project RE. It's actually just harder to use. So it just pulled up first. I adjusted your interest rates to 8%. How long do you think it's going to take you? 9 months to build it and sell it?
Between the permit and the builder and seller, yeah, 9 months.
And then I put in an additional $5,000 for those other costs you talked about. We have insurance at $800 annually, utilities at $200 a month, which is probably a little high. I mean, you have $76,000 in profit on the deal.
76.
Yep. So, and that would be paying a real estate broker 6%. And when you guys sell in New Orleans, do you have a transfer tax?
Yes, like I pay the time. I pay the time. I keep it, and the new owner pay whatever part
Do you know
whatever
how
is.
much that is? Like in Washington, it used to be 1.78. Now it's on a scale depending on the sale price.
No, I don't know. When you're talking about what are you talking about? Property taxes, or you say about the transaction?
On the transaction, we have to sell.
No, no. I have to do that with my my CPA have to. They give me net how do you say? They give me the check and I have to pay my own taxes.
Oh yeah,
I
that's
don't know.
federal. Is there a state tax when you sell at
No,
all? No. Okay.
no.
So if that goes to 0,
Mm-hmm.
you're looking around like I would say 80 to 85,000 in profit.
And I will hope I have my license for that because I'm working on my license.
Okay,
I
so
can
then that
I
goes
can save
down
some
to
money.
3%.
Mm-hmm.
Then you're at 91,000. I'd say 90 to 95,000.
Oh, okay. So the only the only thing is I have to basically have like $30,000, and I just start the duplex, and I'm tying money, so I don't know. I can get a little equity in another property and invest in the new construction. What do you think? I don't know. We don't have a crystal ball, so I don't know. But I see houses selling faster here right now for 285. New construction is selling really faster right now.
Okay, so 285.
But that's I don't know. I don't want to sell it for 285.
Well, and it's just good to know what your caps are because I mean you guys build pretty efficiently down there, and
Yeah.
so if it takes you 9 months with all those costs, and it sells for 315, you're looking 91 to I'd say 90 95,000. If it
Okay.
sells for 285,
Mhm.
you put it in your performa. You're at 60 to 65,000.
So that's a pretty good thing to
Great
do.
return.
Yeah.
It's
Okay.
it's 123% return. I'd take that.
Okay. Yeah, I never considered. I always looking like the rough number, and that's because my husband is aggravated. But now I've been shown this, and he's kind of getting in there.
Yeah, and I factored in your loans 8% and 1% origination too, plus an additional $1,700 in fees just for appraisal and all those things.
Yes. So you think it's and the other deal that I have is a old house. I really want it for me because it's a bigger house. Um, the house is 160, and they need a lot rehab, like 80,000. And for this kind of properties, 80,000 is a lot. The good thing is they have an extra lot. They already went to the city. They told me I can subdivide it and sell the lot, but I don't think so. Nobody's gonna buy the lot right now. But the lot is for maybe 45,000, and we can sell the property for 315, 320, no more than that. That I already well, that's what we think.
Okay, so if you sell it for how long do you think it would take you to renovate it and sell it? 6 months?
No, because actually the permits are really faster here. Well, right now they give me a nightmare because they changed the elevation again. But the only problem with the house is that the flood insurance and the homeowner is gonna be higher. The homeowner is gonna be like almost 7,000, and the float is 1,700. So I don't know when I want to sell it, the people want to buy it because they've been changed the elevation. I don't know wherever you live. I don't know if in Seattle, but here is, oh my goodness, they change it every year. Like the elevation right now, they made me elevate the duplex almost 4 foot from the ground. It's crazy.
Oh yeah, floodplains. We have
Yeah,
that
yeah.
parts of Washington where like North Bend.
Mhm.
This deal's a little tighter. Now the lot makes it worth a little bit more, but the lot's not really worth much right now, so we want to look at the now.
Okay.
And so if you pay 160,000, you
Mhm.
put 80 in, sell for 320, and then you're probably not, are you going to get 8% through your bank or are you going to use hard money at that point?
No, I need her money.
Okay, so hard money is going to be more expensive. So we got to change that
Mm-hmm.
to, let's say, 10 and a half.
10.5.
Yeah, but you want to go get that quoted though and find out what your rate actually is, right?
Mm-hmm.
And now you've good experience. So I would think 10 and a half, 11%,
Okay.
depending on how quickly they fund, 12% will be really easy. So let's just run it at 12%. Like that
Mm-hmm.
we just know that money's there.
Mm-hmm.
Because I know Dom Flips Nola borrows at like 10 to 12% typically.
Yes.
Yeah,
She
but
been
mostly
doing,
12.
I don't know, she been buy houses like crazy. I'm like, she buy like
She's
Two
with little
properties a
cheapies.
week.
Yeah, she moves. She moves.
Yeah.
Great.
Yeah.
And if you sell it yourself, just
Mm-hmm.
take the commission off.
Mm-hmm.
I mean, it's 44,000 in profit.
That's a better word for 44.
And then, but you would have that extra lot that you could build on later.
Yes,
So you
that's
make,
the only I
you
like
make
that
40,
part.
45 and you bank that lot,
Yeah.
which that's not a bad deal. If you're banking a lot and then, you can
Mhm.
build and resell that later, you make another 60. It's not a bad thing.
Oh yeah, because 40 plus 16.
If the
Mm.
lots were 45, it's really 85 grand in value. Or if you build it and you make 60 to 70, then you're making 115 on the whole thing.
Mm. Okay. I should do it because I can that way, I buy the property, I have the lot, and I just have to pay the fee for subdivided. It's like maybe $2,500, and I
Yeah, I
have
mean,
the lot for
anytime
25.
I can make a little bit of money and keep a lot for free, I always consider that deal.
Okay.
Especially since you guys know how to build,
Mm-hmm.
it might be worth doing.
Mm. And this is another question that I have for you. A lot of things we did, a lot of things, but like we have the stock of business, so thank goodness we busy. Because we were only for people like you that they have a lot of money. They building. So thank goodness.
Well,
But
we,
but
we have money, but it goes right back out the door. I'll tell you that much. I always feel rich for a day and then it's back out.
I feel the
And I feel
same way.
broke again.
I feel the same way, but anyway, but I'm in, I have less money than you, but like we building for the people and they not stopping, we building houses for, we will do the stock for houses. We just finished a house that cost 20 millions for a doctor.
Wow.
And so, anyway, so my question for you is, sometimes I have to pay people because my crew takes longer to come in, and I'm aggravated with my husband. But he say, "Well, I need to make money on the other side. You not pay me," but I pay him in the end.
I like it.
So I say, "Okay, you're gonna have your money, but until we sell the house, no, no, no. I need to pay the guys right now, and I know we gotta pay them every week, whatever." So but I have to do like fences, flat work that we can do that. Paint, nothing structural. I sub everything else. But it takes me longer, and sometimes I just want to finish the project faster, so I gotta pay extra. What do you think about this? What I should do?
Um, Speed is a good thing. Yeah,
Okay.
because the faster you get through the project, like let's say this house right here where you can make 34,000
Mm-hmm.
and keep the lot for free.
Mm-hmm.
If I get that done and I make 25,000, but I get it done in 3 months instead of 6,
Mm-hmm.
like let's say it's 6 months, I make 34,000 times 2. So that's 70 grand I can make in a year. But if I can do it for 25,000 4 times over, I'm making 100 grand in a year.
Okay, so
And
faster.
so it's all about how fast you can get it done. Now, if you're getting it done 1 month earlier and it's
Mhm.
costing you $10,000 more, maybe not worth it. And so you
Okay.
want to look at what's your monthly payment, but then how quickly. So I always look at that, go, if I can take a project and make 50 in 6 months, or I can make 35, even 30 in 3, well then 4 times over, I can make 120 grand versus 100 if I do it twice. So I look at how quickly I can get in and out of deals.
So don't fight with the husband.
No, don't do that. That's never worth it. My number one rule is keep my life happy at home. I just do what my wife tells me to do.
No, he's not. He's not like that. He say, "No, I need to finish it before I can jump in. Wait for me."
He's well, and he's also putting in the work too, right? So you got to look at it both ways and go, okay, how does the flipping business, building business help the construction business? How does the construction business help that business?
Yeah,
And
yeah,
if one's getting beat up, then it's not as good of his business, right? They both need to be doing okay.
Yeah, it's okay. All right, so I'm trying to working on that. Okay, I consider, thank you for your time. I consider I think I'm gonna get the old house. And I think I'm convinced the lady to sell me the house for cheaper than 160.
There you go. I like that plan. Get it for
She
140.
she's I mean she's been dropping the price, and because the house need a lot of work. And I was like, I can get it for 140. She said, let me think about it.
Well, tell her it's gonna be 130 in a month if she don't take it now.
Well, well, thank you, James.
Yep, for sure.
I'm here, okay? I'll wait and I'll listen to you and I'll read them.
We'll keep going. I want to see those units get built.
Yeah, as soon as I'm finished with the freaking elevator thing. Oh my goodness. All right, thank you. Bye-bye.
Bye. All right, we have Lynn, Alex, then Jason. So Lynn,
Sorry, let me turn off my thing. Yeah, sorry. Yeah, I had a question about the raising money part and like the down payment part and having two loans. Like say the hard money is to purchase and to rehab, but
Yep.
then as far as the down payment, I was wondering how that gets structured, because you're saying some people won't allow that you'd have to bring that yourself or that you borrow it. But what are the boundaries on that? I guess is,
oh,
does
okay. So
that
the
make
lender
sense?
will.
What I'm
Yeah,
saying?
we have to ask the lender, but typically, what it is, it's a recorded deed of trust against the property because the hard money lender is concerned. Let's say you borrow money from me for your down payment, and the hard money loan is for 6 months, and I'm giving you a loan for 3. They're going to say, well, what happens at the end of that loan? It can be jeopardized. And so when you're raising the money for the down, you just want to ask the lender, hey, is it okay if I take on a second mortgage?
Mm-hmm.
If they go, no, you can't do that, say, okay. And then we know to not take a, because if you wanted to borrow money from me, I'd want a second mortgage. I'm going to record a deed of trust and a loan doc against it.
Mm-hmm.
If it's someone else that might know you well, like I know some people that know me well, right? Sometimes
Mhm.
they'll just lend me the money because I'm like, hey, it's going into here, but it's with a joint venture instead of a deed of trust. That's
They don't
riskier for
actually
that
make you
person.
go on the deed then?
I go on the deed personally. Or if it's a joint venture, I'll give them a personal guarantee sometimes and then they get crossed up a bunch of different properties. Now I don't do that often, but that would be a way to get around it. So what you could do instead, if the lender says no on a second mortgage, what you could do is a joint venture. And the joint venture would be an agreement between you and the investor that doesn't, stating the terms. And the terms would be this interest rate and this points, or it could be percentage of ownership. And that's recorded against the title, but it's not a second mortgage, so it doesn't trigger the due on sale clause. Because what the lender's saying is you just can't have a second mortgage. And so you basically would raise it and do a joint venture.
Okay, so
And-
that's more like the private money strategy then.
Correct. Yeah, it's
Yeah.
the private money. It's how it's being recorded against the property is
Mhm.
really because these big soft money lenders, that's a covenant with the people they sell their paper to. So they're not allowed to do it. With a guy like us, hard money, we don't care. We just want to know about it and what the terms are.
Mhm. Right, because you
But
want to know what you're all in on the debt so that you figure that I could support it.
yeah, that it's
Yeah.
going to be serviced because the last thing I want is a second loan to go into foreclosure as I'm in a first.
Mhm.
And
Right.
so that's the concern. So what you would do is the private money do a joint venture agreement. In the joint venture agreement, you can either make it loan terms or you can make it percentage of ownership. That person is still secure because you're recording that as a cloud against title that escrow will see, but it doesn't go on as a deed of trust and a note that triggers that due on sale clause on the first. Does
So
that make
that's more
sense?
more like a promissory note, you mean, in a way?
It's not a
Or it's
promissory note.
no?
It's a contract between
Okay.
you and the investor, and it's recorded against title saying, hey, before I sell, this comes up as a cloud.
Okay. I
And
see.
so a promissory note would trigger because a promissory note needs a deed of trust.
Oh, right. Okay. Yeah.
But you could also sign a personal guarantee with a promissory note and just give it to them along with that joint venture if that made them feel comfortable.
Mm-hmm.
Like if I was doing any kind of loan that way and someone's like, yeah, just a little concerned, I'd be like, well, I'll give you a personal guarantee. Then I would be giving them that personal guarantee deed of trust and give it to them.
Mm-hmm. Yeah, because
Or
that's kind of
if
okay.
you own a different rental property, you know, sometimes you can do the joint venture and then record the deed of trust as cross collateral against your other properties so someone feels comfortable.
Mm-hmm.
And that has nothing to do with your funding. It's more about raising the capital side.
Yeah, because I was just trying to figure out how to raise, like, I mean, obviously, like, right now I'm in Chattanooga and Georgia, but I'm trying to figure out if there's a possible way for me to do it here where I live, which is, you know, the stupid California expensive.
Oh yeah.
So I'm
Yep.
trying to figure out, like, is there a way to like the houses I own there, is there, I was talking to a lender today, is there a way to like, you know, pull the equity out of those houses on a separate loan that has nothing to do with the one that I would buy? You know, to get the down payment money?
Yeah, and that would be more a hard money lender than a soft money
Mhm.
because they won't pull the money out for you, but they'll do a cross collateral where let's say you have a bunch of equity in a bunch of houses.
Right.
If their loan goes on the house that you're buying and across a bunch of rentals, they're going to run those numbers and go, well, you have this much equity. We can
Mhm.
actually give you no down payment on this one over here because
Mhm.
it's covering them to where if
Oh,
you
I
go
see.
sideways, they can go, well, we can foreclose on all of this.
Mhm.
And, you know, we have equity there. And
Right.
so, you know, be careful about doing that. But it is, lenders will consider it soft money. That's typically going to be like a private financing hard money company that does that, though, as a
Mhm.
second.
Okay. Yeah, because I was thinking, well, okay, because it's not on the house, then it's not a second, actually. It's just me pulling equity out of my other properties.
Yeah, and that's like a HELOC, not a cross collateral.
Yeah, not even a HELOC, like, you know, like a cash out or, you know, like just pulling the money out. Period. I don't know. I went through a bunch of scenarios with a lender today just to see if that's possible.
Yep.
And they said it was possible. Not necessarily that they would be the hard money, but that they would pull the equity for me out of the
Yes, that's the other option to pull it out. Sorry, I got your yes, you could look in the investment HELOCs have been tricky on investment properties lately, especially when rates
Mhm.
went up.
Yeah.
But it is an option. There's not that many lenders, but your local credit unions are good. So like my business bank, um Bank of Arizona and Umpqua, they'll actually do them on our properties if we want. I haven't taken one yet, but they will do them. And so the local banks are usually pretty good, or your credit unions for those.
Mhm.
You're going to be paying probably like 9-10% on those, on the
Mhm.
HELOCs on investment.
Right.
Um,
Yeah.
it's so it is an option, and then that has nothing to do with it doesn't matter if you're getting HELOCs, that won't affect your purchase. Like they don't care about that.
Yeah. So they're not really caring where that I got the money from, as long as it's not, you know, a second on the property that I'll actually buy. Is
Yes,
that
or
what you're
just make sure
saying?
they're okay with that second.
Yeah. Okay. Oh no, mine is really complicated because I don't have W-2 income. So I have to go through like mine is even more complicated
Oh yeah,
than just
I'm
that.
with you. It's
Oh my God. Like,
and you're
no,
in
I was,
California, so you don't want to show much income.
yeah. Oh no. No, I was like, okay, so can I get a DSCR and like pay the penalties and the higher price? I mean, if the money, if, you know, if the deal makes sense, then do I care if I pay all these fees to pay it? He's like,
No,
well, no, you don't. It's just the cost of doing business.
yeah, that's
So,
exactly right, you guys. If you want to get a DSCR loan, like even I was talking to somebody like, hey, my property's taking a while. The thing was listed for like $2 million. He's like, I might. His rate was like I remember. I think his rate was around 11 through a different lender. He's like, I might just refinance a DSCR loan because I can get 7%, but they have they had a 3-point prepay. And I was
mhm.
like, well, just you got to run your interest spread and see if it's worth the difference. And, you know, for him, He's like,
Right.
it could take a while. So he's like, it's going to make sense. Now, if I thought I was going
Well-
to sell it in a couple months, I might not do that.
Well, I mean, that's what I was talking about. It's like, okay, if you hold on to your DSCR for 6 months, then you don't have a penalty. And I was like, well, by the time you buy something, rehab it, sits on the market for however long, it's not like it's a quick sell here per se. It could be 6 months. And
Oh,
even if there
sure.
was a penalty, does, does it, what is the penalty? How much is it?
They'll tell you. So they're gonna your lower the rate, the higher the prepay. The higher the rate, the lower the prepay. So it could be like 8.5% with a 1 point prepay, or it could be a
Yeah.
6.5% with a 5 point prepay. So it's that you just have to. The DSCR lender
Yeah.
can give you a schedule on rate and prepays and timelines.
Mm-hmm. Yeah, but that's what I was trying to figure out, like, how do I raise the down payment without, and that was my strategy, is to pull the money out of the other houses.
No, and that's having access to a HELOC is especially no matter what, it's good to know whether you can get a HELOC on those properties anyways.
Yeah, I don't
Because
think I can, because you need more documentation for that. That's why I was kind of grilling him about the other route,
the DSCR one,
Mm-hmm,
yeah, the DSCR would be based on your rent rolls only
mm-hmm, yeah,
and in appraisal. So
right,
really what you'd be doing is refinancing out the money to buy this other one. And you're really just eliminating your cash flow because your current rate's going to be a lot lower.
right.
And
See, these are on houses that I own outright, so.
gotcha.
Like, I
So
don't care. Like, okay, I pay it off, close out the loan, as long as the money makes sense, it's not like I'm getting out of a cheap loan into an expensive loan. I don't have a loan.
yeah, no, you could
Yeah.
pay it off. Yeah, I would just factor that against let's say you're getting a loan for $100,000 between the two, and you're buying a flip that you can make 40 grand on, 35 grand on, even
Mhm.
like
Right.
let's say quicker deal.
Yeah,
If it costs you 5 points, that's only 5 grand in expense, and you're still making $30,000 over here.
right.
And so, that could very well be worth it. You just got to look at the profit and then what it cost you to borrow that loan.
Right.
And if
Yeah.
you think it's short term, go with the higher interest rate and the lower points.
Mm-hmm. Okay. I see what you're saying. Yeah. Because I mean, kind of my whole thought process, well, okay, it's not 12%. I mean, they're telling me like 8. So,
No, the DSCR loan should be 6.5 to
Mhm.
9,
mhm,
and an 8 one should have like maybe 1 point to 2 points in prepay. Your 6.5 is going to have a little bit more, 3 to 5 points.
right. Yeah. Yeah, at the
So
low end, I think it was 6, 8.
ask for a schedule, like your DSCR loans. Hey,
Mhm.
what's your available rates and the points that are associated with it and prepays? They should be able to give you like 3 different tiers.
Mhm. Right.
And if they can't, let's find a different DSCR lender. There's plenty of them.
Right. Yeah. No. The guy I talked to today said there's just so many and so many. Like, he basically told me it's like the Wild West out there. So
Yeah,
you just gotta
who's the lender?
geez, it was somebody in South Carolina. Yeah, I didn't
They're all
even-
selling them to the same people.
Yeah.
So it's they
I know
just
it's a
charge differently.
broker. It wasn't, an individual broker. It wasn't like, like a company.
Yeah. Yeah, you guys price out DSCR. They're all pretty much the same product. It really just depends on who the person is packaging it most that understands it. But
Mhm.
there's so much of it out there and they're all kind of the same product. You just want to price it because sometimes you're talking to 3 people down the road where you want to just talk to this guy and it's a little bit lower and talk to this guy. And so
Mhm.
there's a lot of white labeling a DSCR right now.
Right. So just get as close to like the actual lender source.
Yep, correct. Like
Okay.
certain lending is a decent one. There's
Yeah, this one was one of that where they were more direct. They weren't just packaging everyone else's.
okay, so he should be able to give you some tiers then. If he can't
Yeah.
give you tiers, he's selling the money.
Right. Yeah, exactly. Okay. All right, yeah, that was my question. I'm just trying to figure out how to raise the money if it's even
No, DSCR
possible.
loans are a lot easier to get, especially with your scenario. California, you don't want to show income. DSCR is a
Yeah.
good route on that.
Yeah, well, it's just that I can't. I don't have the paperwork. So, yeah.
Do you get your rent in cash?
Yep.
Oh, that's gonna be tricky. Can you
Yeah.
do it in cash?
Well, I mean, I have a track record and all that.
Okay.
Yeah.
If you
Yeah,
have the
'cause
track record,
I am actually have one for purchase right now, that Georgia house that I was telling you about. Yeah, I've managed to get one for that. But yeah. I've got enough documentation that I can do that. It's just,
okay,
I don't have W-2s and I don't have, yeah,
that's
I
okay. The
don't have the
DSCR doesn't
space.
need W-2.
Yeah. So that's why I'm going that route. Yeah.
Yep.
But I'm just trying to figure out if I can make that scenario also like work to flip a house here. Just because I mean, like a house here, a flip house, 650, 700.
Yep.
That's just
Unless you go
what
to
it
like
is.
Riverside or somewhere like that.
Yeah. No, I'm in Thousand Oaks. So
That's not expensive. It's a good spot.
yeah, it's a good spot.
Yeah.
Yeah. So it's just a question of really raising the money,
Yeah. Yeah. And there is some markets right around there that are a little bit cheap. And they sell well too.
Mm-hmm. Yeah, no,
Uh,
Thousand Oaks is a place, it was like the 1 and 2 place to move for like a long time. The schools are really good
Yep.
here. It's all of that, where you'd want to move to raise a family. The
Yep.
weather's great, blah, 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 all of
It's
that.
like Tustin and all those other areas too. It's just like good quality place to live.
Mm-hmm.
Yep.
Yeah, and it's been that way for a long time. So, yeah, I don't think it's a risky market. And it's actually still growing. They're doing a bunch of Amgems here, and they're doing a big expansion.
Yep.
So, just more people trying to move in here. So yeah, it's just that's what I was like looking at. Is just trying to figure out if there's a way to raise that kind of money for
Yeah.
me.
DSCR is the best route for you. For
Okay.
sure.
All right. Cool.
And then for some reason, if you don't get a schedule out of them, post on the Facebook page. I can drop in some people that you can call.
Okay.
Yep.
All right. Sounds good. All
Cool.
right. Thanks, James.
Alex, then Jason.
Quick question. Um, if I have an agent submitting an offer for me as like the buyer's agent, but they're trying to give me like one of those exclusive contracts or whatever, what do I tell them? Can they do it just for this specific property? Because I don't want to sign that, but I guess they need it.
Yeah, the buyer's agency agreement.
Yeah.
Yeah, just say make it property specific. And then also, I
Okay.
just like to have people throw it in their email, like, hey, this is for this property only. If you find someone elsewhere, not through me, don't worry about it. That way you just have it documented.
Oh, like have them say that. Okay, cool.
Yep. You guys, I always like to get everything in writing.
Me too. Yeah.
It's just, to say, I'm totally cool signing this, but, I just want to make sure, some brokers get a little weird.
Yeah,
Which I don't understand at all. Like,
I
someone
know.
don't want to work with me, then we're not, they just don't need to work with us.
Yeah.
And we should only get paid if we find them a deal or sell them a house or sell a house. So it's, but yeah, brokers can be a little weird. But that it's basically pretty property specific for that.
Okay, because whatever he sent me is like an exclusive thing, and then he put the property address. He agreed to do that, but I think I'm gonna like have him put in other terms that like it's specifically just for this property. Because I'm just does that make sense?
Yeah, the
I don't know how
address
you
in
guys do
there
it.
should cover that though. That's basically
Yeah?
saying if you buy that property for the next 6 months, you owe them a commission, essentially.
Okay, which I'm fine with that. Okay.
Yeah, then
I
that should
wasn't
cover.
sure.
But then in the email body, I just have him clarify it. That way he doesn't have to mess with this contract a bunch either.
Yeah, I didn't want to be annoying either. That's why I wanted
Yeah.
to ask.
Yeah, I just
Okay.
say, hey, I'm good with this. Send it over. Just in your email body when you send it off to me, will you just make sure you clarify? I don't want to have you update your contract, but then I have something in writing too.
Okay, cool. That's all. Thank you.
Yep. Yeah, you guys, because brokers have fiduciary duty, so if they're lying on that, it wouldn't go well for them. So, Jason, what's up, buddy?
Hey James, how are you?
Good, man. How are you?
Good. I was at Kirkland. I'm trying to bang that out. We're making progress. We're moving fast though.
good. The market's heating up right in that price point, so that's good.
Really? Is that what you're saying?
Yeah, I mean that's a good price point right now in the east side. Like it's a healthy buyer pool when you're kind of in that, I would say 1.2 to 1.6 range.
Yeah.
Yeah.
Perfect.
Yeah.
Cool. Yeah. So my GC he was like, oh, in the original quote for the exterior paint, we only have 2 colors. I didn't know you were doing 3 colors. So I'm just going to do some of the stuff myself just to save cost and just doing hard labor.
What was the third color?
It's kind of like an extra white because we're doing here, I'll just show you the picture from Megan.
Yeah, I just tell her, hey, this is in the budget. Give me a 2 color scheme.
Yeah. We're already doing it and I don't mind painting it, so I'm just gonna bang this out.
And
Right,
he's not wrong. I mean, more colors, the more it costs because they got to prep it and tape it off
yeah,
more.
so that's the color we're going for.
It looks good.
Yeah. So
Um,
it's stone, oyster white, and then this is I believe is extra white.
yeah, we need that trim to pop.
Yeah.
And I do like that it layers it a little bit.
Yeah.
I mean, I would say, like, come on, bro. It's half and half. Like, it's not like a lot of taping off, but I mean, what's he want to charge you more for on it?
He's gonna charge me like $800.
What?
Yeah.
Why?
Because he's saying it's a lot of work, like you gotta tape it and stuff.
I mean, he is true. You got to tape it off because otherwise they can just go spray and then they'll hit the millwork after.
Yeah.
I mean,
Yeah.
at the same time, I don't know if you need to do that too. You could just do gray all the way around too, dude. I think that'd be fine.
Right.
And keep the white trim. You got to keep that white pop,
Uh-huh.
but I don't think you have to layer it that way.
Okay. But this look good though.
Yeah, I think it looks clean. It gives it some dimension, but your house already has dimension because it cantilevers out. So I wouldn't be overly concerned with the
Okay.
color on that. But I think nice warm colors. I like that it blends in and it transitions well. I think it looks good.
Yeah. Okay. Perfect. But yeah, I'm just working that through and I'm doing some hard labors, which I've never done before. So this is
That's good for you.
it's very good for me.
It's good for you.
Um, my question, I guess it's not really a question, but I'm more so I just want your expertise on. Are you feeling okay or are you exhausted?
Oh no, I'm good, dude. I got your questions.
Okay. All
Yeah.
right. I want to, consider your energy and
No, you're good, dude. I always got energy for you.
okay, perfect. So this is the property that I'm working on for this property I have under contract in Beacon Hill. My architect, which I found one, and she came up with some plans, and I want to get your thoughts on it and get your set of eyes on it and see what you think about it. Um, Let me pull
Question:
up.
whatever happened to that little crappy house that you had that was like cheap but just the weirdest thing?
Oh, the Magnolia one?
Yeah.
Well, it never went through.
That's a really hard property, dude.
Yeah,
The low basement crushed that deal.
yeah. The seller was like, "Well, you have the obligation to perform. If you don't perform, I'm gonna call my attorney. I'm gonna sue you." But I never heard from him again. So
Yeah, that's a tough one. Yeah.
yeah. But I think some other wholesaler tried to tie it up, and
That's a tough thing to sell. I know that.
you know, you know, yeah. So I haven't heard from him, but I don't want to talk to him either. Let me see. I'm trying to pull up the floor plan. My apologies. Give me 1 second. Where is this thing? Oh my goodness. No. There we go. Okay. Thanks for your patience.
Oh, you're all good, bud.
Okay, you see this? So this is the existing floor plan, and this is what my architect proposed. And now that I'm in Project RE, I'm learning that the flow of the house and everything is very important. And this is the two plan that she came up with, and I want to get your thoughts and see what you think about her two options.
Okay, so front door is to the left of the living room, right?
Yes, that's the front door.
Sorry, like faces right up in the camera, but
So currently it's a 3-bed, 1-bath, just 1 story. And it's about 1,200 square feet.
okay, so I'm gonna grab this for a second. So this is your as-built to the left, right?
Yep.
Okay, and then your main structure wall is where that TV is too, right?
Say that again?
Like this is your main structure wall is that black line running through or right here.
Yeah.
I don't love how tight it is inside the house.
It is very tight. It's like long and narrow.
Yes. Because you only have 11.9 in your living room. That's pretty tight.
Yeah.
I feel like this hallway's eating up a ton of space here, dude. Your dining and your comps are all 3 2s, or are they 2 2s too?
3 2s.
Okay.
Yeah.
Why don't you look for some comps to see if there's any 2 2s too? Because sometimes a 3 2 will 2 2s will sell for as much as a 3 2 in this zone. Because it's about the livability of it. I like having that third bedroom, but part of me was like, one option I would consider on this house, regardless,
Uh-huh.
is can I draw on this? I gotta go and paint first. Let me see. Like this TV wall area here.
Like right here?
Yeah, let me put this in paint real quick.
Okay.
Shoot. Let's look at this. You guys, things I like to think about, like sometimes just like the livability is a big factor, and this living room is pretty tight. Like someone's gonna be having their couch, their door's gonna swing right into it. It's gonna feel a little bit tighter right there. And so actually, I don't know if this is gonna help. Let's see, okay, let me look at your option B and A. I definitely like option 1A better because the walk-in closet. What's the price point on this house?
I got it for 430.
Or what are you selling it for?
Oh, I would like to keep this as a rental if possible. But I'm aiming at 700.
Okay, 700.
Yeah.
Okay, so I feel like the buyers will value a walk-in closet more than a big pantry laundry area.
I see.
Depending on the price point and the demographic that we're selling into,
Yeah.
I think it's a younger buyer and they're gonna want their space more.
Uh-huh.
And so I would keep option A for floor plan wise, at least in the bedroom situation. I
Mhm.
like the kitchen better, and I would put the kitchen in option B in option A.
I see. Okay.
I think it's a more usable kitchen.
Yeah.
Um,
Okay.
and then one thing I was trying to figure out, like on bedroom 3, I want you to look at comps one more time. What's going on with your front door? Can you move that? Or is it pain?
I could. I think I could.
Because the only thing I don't like is how tight your living room is. Your dining's okay. But
Uh-huh.
like, I just know that this can be, we need to dig into the comps a little bit on this and figure out
Uh-huh.
who's buying it. Let me share my screen real quick.
Okay.
Um,
You want me to stop sharing?
yeah, that'd be great.
Okay.
So livability wise, I don't like the 10 feet. That can be problematic for resale. I just feel like they don't have enough space. Your dining room's great because this cantilever's out, right? So you got a lot more room here.
Mm-hmm.
One option I would consider on this deal is suck this wall back here and do French doors
Mm-hmm.
because it can be an optional bedroom
Mm-hmm.
and it still has access into this hallway, right? Open this up,
Mm-hmm.
but it also gives them something they kind of open this space up with, right? So French doors here, glass here. And if the door got moved down, your front door came here. It's just going to make your living room feel a lot bigger.
Mm.
And you still got the bedroom count. It's an optional space. They have access in the bath. And I'm not pinching this living room. It gives you like an extra 3 feet there.
Mm-hmm.
And if it was me, ideally, I'd want that to feel bigger when someone comes in the front door.
Yeah.
I don't love that they come in the front door and see a hallway. So you could, in theory, put like a coat closet here, right?
Uh-huh.
But then you do pinch the access through here. And so that's kind of a catch-22.
What does that mean? Catch 22?
Oh, it's just like if I put the coat closet in, it's better for an entryway. You have some glass. Your coat closet goes here. That's normal. You come into your living room, dining room, kitchen.
Oh.
But what it's not for is if this is a bedroom, the person's got to go all the way around.
Uh-huh.
And so it's like, again, I don't love having like a hallway there where you come in because that's their
Yeah.
first impression.
Yeah.
But it just makes this room feel bigger, right?
Mm-hmm.
And I feel like this space could use it's gonna make a big difference on that main floor.
Definitely.
Maybe have her mock something up with that idea. I try to get this living room bigger. I think otherwise, I would make this the walk-in. I like this kitchen. I think this feels good all the way through.
Uh-huh.
But I feel like it's a little tight.
Yeah.
And a lot of Beacon Hill, Columbia City houses are shotgun houses where they are narrow.
Uh-huh. Wow, that's genius. So where the original wall was, would you just put a beam up?
Yeah, they'll probably have to put a beam in here,
Okay.
catch the load, but it's not too far of a span either to where they can catch that without being plan review.
Yeah. Gotcha. And then the rest you would just keep it as a wall.
Yeah, I just keep that to keep your load point.
Okay.
Because then you still have defined space coming through. I
Right.
mean, might not be the end of the world to have a hallway here. What you could do is do one of those like bookshelf doors,
Yeah.
but no, that's too much. But I just feel like this needs to get bigger.
Mm-hmm.
I mean, you could even kind of bring this back even a little bit more and then line it up with that door frame. And then this is now going to feel a lot bigger. They can reposition their couches this way, put the TV on this wall.
Yep. Yep.
And
Oh
then if I
wow.
was going to do that, I'd make like a little window here and a
Uh-huh.
little window here.
Uh-huh.
And then I would put this like this. So then your TV goes flush. Now your couches can go in this section through here. You know,
Uh-huh.
or and then it's like they flows through, or maybe you do your couches like this, right? It just
Yeah.
it's gonna feel way better.
Right.
Now, but if your comps do all have tight, narrow living rooms, then forget it. It's all good. But
Uh-huh.
I just that is gonna be pushback.
Got it. That is so genius. Wow. I would have never thought of that.
And another thing, dude, this is a lot of space here.
Yeah.
You could just frame this back so it's flush with this wall here. You won't even notice it, depending on how this lays out, and put your washer dryers here, put them into the hallway.
Wait, say that again. What does flushed mean?
Oh, so like, see this, you have a wall here blocking in your kitchen.
Yeah.
You basically try to keep it at the same dimension here.
Okay.
Actually, I don't know. Let's leave that open.
Okay.
That's, yeah, I think the flow, you just don't want to get pinched in this corner here.
Yeah.
But I would think that this is your bedroom 3 is going to be kind of small office. But if they don't care about it, they can open this up. This can be a secondary, like we did in Kirkland, right?
Yep.
It's that flexible space feels good. And honestly, you come in your front door, you got nice glass doors going into your office / bedroom. It's going to feel good when you come in.
Yeah. That's amazing. Okay.
Good primer though.
Yeah.
Yeah.
I'll have my architects drawing something up this week, and then I'll bring it to you again next week.
Cool.
Thank you very much. Appreciate it.
Yeah, it looks good, dude.
Thank you.
Nikki.
Hey James, sorry I missed asking one question earlier. This developer is also asking, like he also gave an option whether we wanted to join him in partnership for the development, and we said that we don't know at this point, because what we were thinking, if we involve with him, he will ask to contribute against the utility and everything. Do you think it's a good idea to give him some intention that yeah we also plan, or just involve with another builder like Murray Franklin or?
Depends on price. What's he offering on the term?
Yeah, he wasn't that friendly, but yeah, maybe I'll check again with him.
I mean, if the guy's not willing to talk to me up front, I probably don't want to do business with him anyways.
That's right. Yeah.
But if you want to join, it'd be like, hey, well, you said partnership. What does that look like?
Correct. Yeah.
I mean, that's the thing. You can't really throw a partnership without what it is.
Mm-hmm. Yeah. Sure. Yeah, and also meanwhile, I was thinking like I should at least try with one cosmetic flip, but since the Redmond thing is going, and I just don't want to stuck forever on this and start doing some kind of cosmetic flip on the side to earn some income. I know it's like a very big scope question, but like, what do you think? Which all kind of location or like the a safer option I should try out to start cosmetic flip. And it's not like very first, I very completely newbie here, because even this Redmond house we had to do like carpet and painting and all those things. So yeah, I do have some understanding, but I wanted to try out the actual flip. So what do you think, like what all location and the safer bet?
Well, it kind of depends. Did you go through Project Flip?
Yeah, I am just going through it, and I know I need to create the team and all, yeah. Which I
Okay, yeah. So, and it's about kind of looking at the buy box first, right? Which is, on the buy box side, it's what, like, first, how much cash do you have to invest in a cosmetic flip?
Actually we can bring some cash. Obviously not much because just don't want to be in surviving kind of thing. But yeah, maybe 100K.
Okay, so 100 grand, that's going to get you kind of like, you're going to want to be,
Or
we're going
maybe
to want to kind of be in
better.
North Snohomish or South King. That's
Okay.
not going to get you into the east side.
Yeah.
And that's okay.
Mm-hmm.
Honestly, the east side margins are tighter
Yep.
because that's where people want to be. And for especially a cosmetic flip, it's hard to. I mean, we just did sell a cosmetic flip in Redmond for 119, very, very cosmetic. It's worth 1.6, but it's still, you just need a couple hundred grand to do that deal.
Okay.
And so there's no less risky way to do it because it depends on the price point that you're in. Like, you could be buying a cosmetic flip in Bellevue and you're trying to sell it at, let's say, Lake Hills for $2 million. That's the slowest market there is right there.
Okay.
And so it really depends on price points. Were you on the call when I was talking about price points?
I think I missed.
Okay, so check out that recorded call. And it was the one about, should I drop my price or not?
Okay. Yeah, I think I was.
Because
Yeah.
yeah, that one talks a lot about like velocity and where things are moving. And you know, do you have a broker that you're working with?
I'm thinking of working with Tiana or Nico. Yeah, Hayden Dynard.
Yeah, and so what you want to do is you want them to break down like, hey, what's moving? Like anytime that they're looking at anything, it's going, okay, what's moving and not moving, right? And there's different price points, and we do a lot of training at our office around that when we're looking at deals, especially right now. And so when we're underwriting them, we're going, okay, well, we need more margin if it's a slower one. And so that's the first thing I would say, cosmetic wise, where we want to kind of go. I think that's a healthy buyer pool is I like North King, South Snohomish, right? Because they're going to be a little bit newer houses. There's plenty of buyers in there because they have good schools, good infrastructure, lower crime. And a lot of those homes are built in the 1970s or newer. That's what we want to focus on. You don't want to buy anything below 1970
Okay.
because that's if you really want cosmetic.
Okay. Got it.
Even condos, you guys, right now, because the condo market's so dead, there's some buys there.
Okay.
They're hard to find, but it's those are very cosmetic. But I would say, like I like Renton, Newcastle, Kennydale. They have a little bit newer houses, good, healthy buyer pool. I would look at Bothell, Edmonds, Linwood, even parts of Kirkland, like a little bit smaller houses, maybe in North Kirkland, like Totem Lake. Those are kind of going to be in your price points too.
Got it.
Because Bellevue's just hard because the average price on a deal is going to be $1,100,000 to $1,250,000 just to buy it.
Right. That doesn't
And,
make.
and then also that's where you have that big monthly payment too.
Yeah.
And so, I would try to focus on definitely that North King is the healthiest. And I would go, I do like renting a lot, especially, there was a deal I know got done recently that was like $435 in Renton.
Okay.
Need a lot of landscaping and cleanup, but overall it was like cabinets, doors, trim, just a very cosmetic.
Okay.
And then that one's gonna need well less than 100 grand. It's like 65 grand to do that deal.
Got it.
And so I would focus on that,
Mm-hmm.
because the older the house, the more issues you're gonna have, and it'll be less cosmetic. And so I would say 1960s or newer.
Okay.
And I think that's important to just express to whatever broker you're working with, whoever it is. It's just, hey, right now, I don't want to. We want to kind of be in and out of deals. Your margins are always going to be a little thinner when you do that, but it's because you can buy, renovate, and sell them a lot faster too.
Yeah, that's true.
And so, the more work they need, the cheaper they are. But it comes with. I mean, I bought one very cheap. I can tell you, I have a lot of work to do. And I have some creative thinking I need to do on it. But I would definitely focus on those areas, North or South Snohomish and North King, and then South. And you know what, South King, even Federal Way, Renton, Kent, like good little pockets. There's great houses in there.
Okay.
And that's where you're gonna get kind of more that starter house where you don't have to add the bathroom. You can cosmetically update it.
Got it.
But primarily 1970s or newer. And for lower risk, we want to stay in lower price points in the market.
Sounds good. Yeah, that helps. Thank
And
you.
I if you want, you can send me the address. I can check with my buddy at Murray Franklin and just say, hey, get me a number on this lot.
Sure. I think you already have the address, or like if we can reach out, I don't know. I try reaching out to Murray Franklin.
I don't take calls off the call. I just Tuesday I try to keep all my calls routed here just because we have a lot of projects and staff I deal with. So I try to keep. That's why I stay so late on Tuesdays. But if it's like to look at a property, if you can, you can shoot me a call and just give me the address. And I mean, the good thing is I know these people like the back of my hand that I'm gonna call on this,
Mm-hmm.
and I'm just gonna say, hey, look, I need the highest number on this house,
Okay.
and they will crunch their numbers. They're gonna tell me, give me a little heads up if there's any issues there,
Mm-hmm.
and then they'll get a number and a term roughly, and then I'll run it by you so they're not like salespeople harassing you,
Mm-hmm.
and then you can go, okay, I'm interested, and I'll connect you guys together.
Yeah, that sounds good. But we were thinking like let us connect with this developer first, what he says, what his partnership plan is. And
Yeah, but you should run that congruent, right? Because you want to know what your other option is, right?
right. Yeah,
And
maybe.
so, like, if I'm selling something, I go, okay, well, I got this person offering me this. It's like when we write up a deal that's a development deal or a flip, we run numbers both ways because we want to get the seller the highest number
Mm-hmm.
if it's competitive. And so we don't go, well, let's wait to hear from the developer. We get the number from the developer, we know our flip number, and then we present whatever the best term is to get the deal done. And
Sure.
so it's the thing about like a big buyer when you have like the big buyers in town I've just known for 20 years. So they're going to give me a range because what if it's only 1.6? We don't know.
Yeah.
And
Yeah.
then that motivates you more to be encouraging with that conversation too, because they're not even going to really come out to your property. They're just going to run the numbers. They know it, and they're going to go, it's going to be right around this number.
Mm-hmm. Yeah. Actually, my husband thinks like we can at least try checking with some architect and see if something we can build by
Hey,
ourselves.
I'm just telling you what I would do.
Got it.
You guys do what you like. This is exactly how I would work this property though.
Mm-hmm.
It's just because honestly, I think you guys are in way over your head on that deal.
Yeah, that's true.
And it doesn't make the property you bought is going to be a massive cash suck for the next 3 years.
Mm.
And that's okay, but from our first conversation, that didn't sound like that's okay.
Yeah, that's really yeah, we are currently on big net negative debt on that.
And
So
so it's whatever, I think you guys do your things, but I think you're kind of burning time and you're kind of guessing your way through. Whereas if you put enough irons in the fire,
mm-hmm.
you actually can come up with a really good plan rather than bouncing back and forth and maybe blowing an opportunity.
Got it.
Because you have an offer on the table right now from someone for a partnership, possibly. Doesn't sound like a good thing, but he's going to need you to sign that document sometime soon.
Yes, yes.
And for some reason, if you don't sign that and they get around it, then you're in deep trouble.
No, we have to sign it.
Yes. So, but then again, what if there's
Mm-hmm.
a builder that will offer you 2.5 million if the document's signed a certain way and only 2 million if it's signed a different way?
Mm-hmm.
That's why you want that number. Because
Got
the number is a number. You don't have to commit to the number. It's to really it's to tell you what your next steps are, right? Like, here's something I have on the table. Option right now, you have 2 options, right?
Mm-hmm.
You have 3. You got sign the easement with them so it becomes buildable, but you don't know what the repercussions all the way are because you're not looking at it like a professional developer.
Mm-hmm.
The second option is you don't do anything and you miss out on the development. The third is you partner with a guy that's not very friendly with you and you don't even know what the math is.
Yeah.
Or the fourth is you build it yourself, but you don't have a builder and you don't know what the utility costs are going to be.
Yeah.
That's why you want the options, because you're 4 on the table right now. You have lack of clarity on all of them. At least option 5 gives you clarity, which is get a number on it to see what it's worth.
Mm-hmm.
Then you know the number. Then I think you guys are working backwards.
Yeah.
And so, but you guys explore any option that you want. That's just the way I would do it.
Okay. Yeah, I mean, really have to do some brainstorming around it. But
That's
yeah.
okay. I'm just trying to help. So it's but that would be, part of this is I tell you what I would do. That's exactly what I'd be doing. Like
Mm-hmm.
right now, I'm meeting a developer at a property I bought because he's like, hey, I was like, hey, what would you do if you carved off this lot? He's like, well, I got some other options and I'm about ready to pull the trigger on getting this renovation going. I'm going to hold off my renovation for 1 week to hear his options, because the option that I have for him right now, I know can yield me a certain amount. I don't know if I really want to do that. He might have a 3-lot option where he's like,
Mm-hmm.
but it's also going to require me to wait 10 months to sell that property. If I got to wait 10 months to sell that property, I'm going to do the renovation different. I'm going to permit dormers. If I don't, then I'm not doing. So I have to know what that number is, right, to make my decision.
Yeah, that's true.
And so that's why you should always work it backwards and congruent and start with a baseline answer, then look for more answers. Because right now you're just digging in a bunch of holes.
Right. Let me check with my husband because when we bought this initially, our thinking was like we are gonna develop at least in backyards, use some kind of middle housing, maybe not demolishing the primary, something, use the lot. So that is what our initial intention is, and like we went.
I know, but that plan, let me just shoot you straight right now. He watched too many YouTube videos. That
Mhm.
plan on the math that you paid for that property does not make sense.
Yeah.
The debt, what you paid for that property makes that thing worthless as a rental for any type, unless you have millions of dollars.
No, we don't.
That's it. So the plan, he bought the concept, not the math. The concept works on the right plan, the right property. On this property, not so good. Because if you build even if you build an ADU on that, which
Mm.
you don't want to build an ADU on that, you want to build a single family house, you'd be eliminating your FAR coverage.
Mhm.
If you build an ADU in that
Mhm.
area,
Mhm.
you're going to be into that still. You're going to have improvements, all this stuff. It's probably going to be like a $500,000 ADU, right?
Mhm.
Your rent on that's going to cap out at $3,500. East Side rents are terrible compared to Seattle.
Yeah, that's right.
So you're going to lose roughly by building that, you're going to end up losing $4,000 a month instead of 2.
But then we can refinance, right? Because the property value will also increase.
But that just means you have more debt, which is going to mean you have to pay more. And then you also have to show that you can cover the debt. It has to cash flow for you to refi it.
Yeah.
So again, he took a concept he heard and put it on the wrong property.
That's
The
that.
good news is you got some dude that's bringing in sewer that's making your property worth more, because I think it's probably worth less than you paid for it right now.
Yeah.
And if that's so that doesn't be developer, it's probably like a 135 property right now.
Yeah. Could be. Could be then.
So I think he's hanging on to it. You guys, and that's an important lesson, you guys. There's concepts.
Hmm.
If the math doesn't math, it doesn't matter.
Yeah. I learned it in the coaching, but this was bought like before, so yeah.
Which group?
I mean here in this coaching, now I'm learning that, yeah.
No, and you guys, it's the right concept. You guys like my buddy Thatch, he talks about that a lot. And he is 100% right, but it has to be on the right property.
Yep.
Like and I'll build. Honestly, I never think it makes sense to build rentals personally. Like it can when you're selling things. Like if I'm ever gonna build something in the backyard, I'm selling the front house to take down the basis. And then I got a nice rental that's brand new construction. It's warranted. It's got some equity in it. But I can't. The math won't work to keep both.
Yeah, that won't work.
Not in Seattle. It's too expensive.
Hmm.
But it would work. Like the property I just bought in North Seattle, it would make sense to do this because I paid $575 for it. It's really cheap. I could put 2 ADUs in the back.
Mm-hmm.
The property is a pile of garbage, though. It is wrecked. Like it is the roof's collapsed in, right? Like, but I can fix it.
Mm-hmm.
But I'll be into that property for 775 or 770, no, 825
Mm-hmm.
after I renovate it.
Okay.
If I put 2 ADUs in the back, which I can build for 350 there,
Mm-hmm.
my basis is 0 on those, right? So the monthly mortgage payments on those are pretty low because my total cost is 350 and they're now worth 700.
Mm-hmm.
So I've created equity, but my payment on those is going to be around $2,000 a month. They'll rent for 3. That means I'm cash flowing $2,000 a month in the front
Yes.
or in the back. And then I can sell that house for minimum 900 after I'm renovating it. I sell off the front house. Now I have 2 brand new houses that are cash flowing me $2,000 a month that I have equity in. If I keep the third house, the deal gets way worse.
Mm-hmm.
And so the concept works on the right property. 1.5 as a purchase doesn't make all. Now, what you did do is you bought a property, it's being rezoned. You want to take that to highest and best use. Highest and best use would be to either explore permitting lots,
Mm-hmm.
getting them planned, permitted, selling them. That way they will pay the most.
Mm-hmm.
Or you give an experienced builder that knows how to put the right layout on the property. Because if you put the wrong house in the wrong spot or you put the wrong weights on it, they might pay you way less for that house. Whereas if I let a builder, and I'm a builder and I will sell to builders this way,
Mm-hmm.
if they get a permit what they want and I give them all the time, they're still going to give me a huge price on the property because they're permitting what they want. And in the east side, builders don't want permitted sites typically.
Okay.
The
Because they.
big builders, MN Custom Homes, Murray Franklin, Jmart, they want to design their own home because they design cost efficient homes to build. And if you design something that's not cost efficient, they won't look at it.
Got it. Yeah, I think
That's why you want to work it backwards.
yeah, that's right. Okay. Yeah, let me
And
connect.
I'm just trying to be direct with you, Nikki, because I see what you guys, and I'm like, man, you guys are floundering a little bit, and it's best just to get answers.
Yep. Yeah, I think my husband has also reached out to some builders recently, but I have to understand who he has reached out. Also, like, what we think should be the best path going forward for this once we talked with this next door neighbor as well.
So question, Nikki,
Mm-hmm.
take a step back, right? So sometimes people don't want to talk to professionals. It's like, ah, it could cost me some money, but then they don't know. Like, so if I'll tell you one thing, if a broker calls me or a wholesaler, they call me with a deal and opportunity, I give them a different number than a seller that calls me and they don't quite know what they can do on the lot. The
Mm-hmm.
number I give to the broker or the wholesaler is going to be higher than the seller
Mm-hmm.
because I go, they don't know what they have here.
Yeah.
Whereas a broker knows what they have. And so just, I feel like you guys are kind of going spread and you're going to bite yourselves in the foot. Because once you spread it out too and you do it in the wrong way, there needs to be like a very concise order of how you do this. You're going to start selling your property for less, and less. Because if he also reaches out to numerous builders at the same time, they all know each other.
Mm-hmm.
And you can start to, I just letting you know the back end of this world. I feel like your husband's taking some very bad steps right now.
No, that could be right. He doesn't know what we had, like, this conversation. I have to explain him.
Yeah.
And we'll go from there. I'll keep you updated, and obviously, as I'm taking your advice, we'll
Yeah. And by all means, do you guys, I'm pretty direct when I see people doing this. I'm like, hey man, you're really kind of biting yourself in the, like, I was just talking to a broker the other day and I'm like, he has a piece of property. He's bringing, I call him because I knew him and I'm like, what are you doing? And he's
Mhm.
like, well, I'm doing, I go, you just burned yourself, dude. And he's like, what? Because he doesn't know development. He bought the property 10 years ago. I'm like, dude, I've had this deal brought to me 3 times. You've called Blueprint, you've called Legacy, you've called this. He's like, how do you know that? I'm like, because everybody talks, dude. And once you do that, no one takes you serious. And your number probably, you just lost yourself probably 150 grand. And he's like, you got to be kidding me. I'm like,
Mhm.
no, dude. Or it's like when Thomas James Homes, you guys, they were a big builder. They liquidated a ton of lots off.
Mhm.
The CEO, who's not there anymore, made the worst mistake he could have made. He put blood in the water and he went and talked to the big guys, then he dumped off the lot. It's exclusivity is what gets you the highest price.
Mhm.
And so you don't want to go to numerous builders at the same time. You go to one, you work the builder, you find out what the highest number is. You look at, is it a good number? Then you have a baseline. Then you go to the next builder with terms.
Yeah. One aspect what he thinks is we wanted to hold also, not just sell everything unless we are too much in negative. Because we need to have some holding as well, like, along with some kind of. So that is where I need to actually explain him, and then we both need to decide like what path we should take.
Well, that's just not the right property to hold.
Yeah.
Not unless you guys want to pay 2 to 3 grand a month on that thing. And that, if that's the thing, oh no, this is our annuity. We're putting 3 grand a month in. That's an investment decision. That's okay.
Mm-hmm.
But I think you bought the wrong one to hold.
Yeah. Could be.
And that, and that's okay. But if you can create value and equity and you 1031 it into something else that you can develop later too, you guys will make 5x more money and cash flow.
Yeah. So this is on primary conventional loan. So 1031 will not work.
Oh, well, that's okay though. You got the 500 grand. You go, I mean, no matter what, if you make 500 grand tax free, and let's say you pay tax on another 300 grand. So you're going to pay a difference of $70,000, but you can take that money, put it into an investment that's going to double in value rather than just kind of, or that can cash flow and produce income for you guys. I like if you put it on a spreadsheet, it will still outperform the taxes.
Problem is we have not even lived in there, because for like it needs to be 2 years living in, right? Even to save 500K tax.
But how long have you owned it?
1 year.
1 year. So a builder's not going to close for 1 year anyways.
But we are not living in there. We are currently renting it out.
Is that on your tax returns?
Yeah, it's on our tax return. So we had some
Okay.
medical, yeah.
So it is a rental property, so you can 1031 exchange it.
Okay.
You can 1031 exchange it. It's a rental property.
Okay.
It just, yeah, it's now if the answer was, hey, we might want to build our dream house here and build some units in the back later, that's a totally different thing, right? Then keep the property.
Mm-hmm.
But I feel like you guys are hanging on to a concept that's maybe you should not be hanging on to.
Yeah.
Right concept, wrong property.
Could be because the very first, yeah. Yeah, but yeah, like let me connect with him and go through all this and see what should
Yeah,
be.
just he's kind of biting himself in the foot right now too. Because the other thing is, if he talks to too many developers and they know the one developing, that's gonna get hairy too.
Okay.
So you just gotta be very tactful with that.
Mm-hmm. Got it.
Jason, yeah, 575. I was the highest bidder. This thing's hammered. Did you see my stories today?
I haven't checked.
Ugh. You guys, I went and bought some meta glasses today, though. I got some good stuff. Now you guys can walk through hoarder houses with me.
Oh shit.
Oh, this
You
one's
could use
gnarly.
mine. I left mine at the Heat and Dana office. You could have just used mine.
What? Yeah. Alex, you got a question, or is your hand still up from last time?
From the last time, sorry.
Oh, no, all good. All right, guys. Well, I think we are wrapped. But I will see you guys next week. And stay tuned on my stories, guys. There's gonna be some gnarly stuff coming through there. This is a good one. Oh yeah. Dude, this upstairs is so packed. I couldn't even it's trash. I can't go upstairs.
That's
And then
crazy.
I got to the back of the house, totally caved in. This is I would say most people didn't think that was um most people say it's tear down, but we'll fix it.
Yeah.
So all right, guys. Well, have a good night. I'm gonna get back to compass some houses.
Thank you, James. Appreciate you.